Hello everyone, my name is Nitin Nahar. I secured rank 6 in my CA final exams in May 2013. I welcome you all on behalf of JK Shah classes to this Indirect Tax CA final marathon for November 2023 exams. Now, before we start topic wise revision, we will see two important aspects. One is the ABC analysis till May 2023 exams, and second, our revision schedule as to how do you deal with that 1.5 days, which is the most critical. So these two things we'll start with, then go with each topic. Now let's start with the ABC analysis. In all the exams till now, 20 to 25 marks of customs and FTP would be there. So we need to be very strong with customs and FTP. At least the easy questions should not be missed out. Then computation of GST payable. There might be one question or two questions. The first question, which is a compulsory question, will always be from this. Now what all can this cover? This computation of GST payable would cover supply, it would cover input tax credit, it would contain some details from exemption. They could also test you on reverse charge mechanism as well as place of supply, and sometimes even time of supply, where they give you a particular adjustment with regard to advance. And normally for goods industry, you don't pay tax at the time of receipt of payment, that is at the time of getting the advance. So that could be tested. All these taken together form part of computation of GST payable, which is the first compulsory question. Then comes input tax credit, supply, value of supply, demand and recovery. There have been questions from demand and recovery, basically adjudication, issue of show cause notice, passing of demand order. This is again a very critical area. Then offenses and penalties. Normally one or two questions have been asked from this topic. Charge, place of supply, exemption. See, charge will cover reverse charge mechanism, composition. Anyways, reverse charge mechanism will be very relevant to us to solve any kind of question of computation of GST payable. So this RCM will anyways be in focus when we deal with computation questions. Then comes place of supply, which is again something which we will deal with in computation of GST payable, but there could be a separate place of supply question as well. Registration, there have been questions at least in all the exams except for November 20, May 19 and May 23. Otherwise there is always a question on registration. Then appeals and revision, again something critical where pre-deposit related questions are generally asked, or the time limit for filing appeal, give the details of how the appeal mechanism would work, these type of questions. Exemptions, normally there are questions asked, but it's about once in 2 terms or once in 3 terms. That's the general trend. Obviously for your exams the trend might be different and altogether completely changed. However, some basic things remain same. 30% MCQ, computation question in the first leg, then questions on ITC, supply, place of supply. One of these topics will obviously have certain questions, and customs will be there in almost all the questions. Then refund under GST, again 2 to 3 attempts once you get a question from refund. And then comes some topics where the questions are a bit rare. Introduction chapter, assessment and audit, accounts and records, e-way bill, payment of GST, time of supply. Time of supply, they generally try to cover it in computation questions. Plus, time of supply is a topic which has been dealt in Inter-C as well. So the focus is slightly less, but going by the trend, somewhere down the line in some bigger questions, there will be something related to time of supply or in the MCQ section. And then comes GST returns, import and export under GST. This is zero rated supply, basically with payment, without payment, all those import and export transactions dealt with, which we will deal with in refund chapter. Tax invoice, credit and debit notes, liability, advance ruling, miscellaneous provisions, job work, and finally inspection search seizure. Now, normally in inspection search seizure, only one question has been asked, that was in November 2021 exams. Otherwise, there has been no question asked from this topic. Now, be very careful about one important aspect. Your question paper, 30% MCQ and then 70 marks is subjective type questions. Here, question 1, which is for 14 marks, is compulsory, and this will contain all the related adjustments from majority of chapters. So you can't skip any chapter. In fact, I will always tell you not to skip any chapter as such. Topic wise, something which is you are finding it difficult, or one day before the exam you just want to be confident that you know the basic very well, that is something which you can just have a look and go. But otherwise, don't skip a chapter, because you never know from where the questions might be asked. So focus on all the chapters, but yeah, focus can be differentiated between the chapters. Then you have 5 questions from where you have to answer 4. These will contain subparts, like these are also 14 mark questions, but these will contain parts, maybe a 9 plus 5 or a 5-5-4 or a 5-4-5, this type of question. And normally the last question, that is question number 6, see, the first question will be compulsory, and then after that you have 5 questions, out of which you need to answer 4. The last question will be completely based on theory. Otherwise, there is a mixture of practical and theory, plus one of the questions in almost all questions will be related to customs and FTP. Normally the trend was that 25 marks customs and FTP were asked, but in May 2023 only 4 questions had it. So that's why you see the weightage as 20. Otherwise, customs and FTP consistently you will find 25, except for November 20 cycle. So this is the general trend with regard to examinations which have been conducted by ICAI. Now coming to how would you take this entire thing in 1.5 days before the examination. Now, all these timelines are given in minutes form. It always helps to plan in minutes, because then you see a bigger number and you will be able to value each minute which you are spending, because at present that's the need of the hour. Hence it becomes very important to value each minute. Now, from introduction and supply till offenses and penalties, this is your 75 marks. This is GST. And from 22 to 30, this is customs and FTP, which is for 25 marks. Now, Be very careful about one thing. There are two headings given here: time for revision and time for practice. This we will do it together. Time for revision. This is approximately for 12 to 13 or sometimes 14. It can vary because every person's style of reading and the time which he will take will vary a lot, and hence this is just a skeleton given which could vary from student to student. So once you do this revision, you will get to know where you are spending less or more time, and you can mention it here so that you plan it very well before the exam. You can also mention your actuals so that you are very comfortable and you know what you spend more time on, because it is very well possible that in some topics you spend less time while in some topics you spend more time. This is what we will be doing together, this entire revision of indirect taxes. Time for practice is something which you can focus on solving questions, solving MCQs, solving case study based MCQs. But case study based MCQs only touch after you have completed till input tax credit, because this is where now you are aware of the process and you will be able to solve most of the case study based MCQ. Obviously there might be some questions related to registration as well in case study based MCQs, but majority of the questions and majority of the cases where we get stuck is related to computation of GST payable, where say suppose a 9-mark question is converted into 2 MCQs of 2 marks. That's the whole point of giving you a MCQ or a case study based MCQ which contains computation of GST payable questions. So be very careful on this one particular point, that case study based MCQ start only after you have completed substantial portions till input tax credit, because that's where computation stops, and then you enter into procedural aspects slowly and steadily. So this time will be yours. You will use it for either revising the topic again or just trying to recollect, because this is one technique which I have used extensively during my exams to recollect various topics which I had completed. I have completed revising a topic and I just try to recollect what I have revised. So next time I was able to recall it much better. Now, these two PDFs will be available to you, and now let's directly get into the topics. We will first focus on introduction and supply, then slowly and steadily complete all these topics. So let's start. Now in the introduction section, first we will be focusing on constitutional provisions. Also, one important aspect, from wherever you have been studying, whichever textbook you have been using, please continue using the same one. In the last moments, you should never change the textbook. You rely on those things. Wherever you want to add something or wherever you want to amend something, please do it. And certain things which you want to write along with me in the video, please do it. But your study material, wherever you have been studying from, continue to study from the same book. At this point of time, you can't change it. Now, whatever you want to write in this, you can write, or just concentrate and listen to all these topics and see whether you are able to recollect these clearly. First, we will be dealing with constitutional provisions. Then we will take up registration limits, Then we will speak about utilization of input tax credit. We will also focus on taxability of various goods and services. Then we move on to charge, that is charging section. We will just do an overview and then go ahead with the next topic, that is supply. In this supply, we will be covering section 7 of CGST Act and section 8, which deals with composite and mixed supply. This is the broad outlook of this first part. Now, coming to constitutional provisions, Article 265 says no tax can be collected unless it is authorized by law. There has to be a law in place, and based on that law, you can start collecting taxes. That's the first discussion. Then comes Article 246. 246 gives the power or divides the power between central government and state government. You had three lists: union list, state list, concurrent list. But this was not sufficient, because in concurrent list, both central government and state government could make the law, but they could make the law separately. In GST, the objective was that both central government and state government come together so that a law which is consistent throughout India can be made. For that, government brought in Article 246A, which provides that central government and state government have the power to make law regarding intra-state supply of goods or services. And the interstate supply power was given to central government, and they do that using Article 269A. Then the issue was, who will be controlling all this? So a constitutional body was made which only gives recommendations. These are not mandatory. These are recommendations, but as you read the law, you understand that without these recommendations, most of the law cannot be passed. That's Article 279A, which deals with GST Council. Now, GST Council has representation from central government as well as state government. Central government representation is by Union Finance Minister, who is also the chairperson of GST Council, and you have Minister of State for Revenue. State government, 31 state finance ministers. Now, how did we get 31 state finance ministers? 28 states plus 3 union territories which are regarded as states: Delhi, Jammu and Kashmir, and Puducherry. These 3 are regarded as states for the purpose of GST. So whenever a transaction is within these places, it would be a transaction of C plus S. Though we'll again be discussing this in place of supply, but be very careful with regard to when do you charge C plus S, when do you charge C plus UT, and when do you charge IGST. C plus S is charged for an intra-state supply within these 31 states for the purpose of GST. Now, you check two things: location of supplier, place of supply. If the location of supplier and place of supply is in the same state or union territory, then either C plus S will apply or C plus UT. C plus S for within those 31 and C plus UT if it is within those 5 union territories. Now, which are those 5 union territories? You need to remember this very well, because when a question is asked, they will just say Mr. A, Andaman and Nicobar, and you have to think properly. You need to apply that SGST will not apply. There might be a C plus UT case or IGST case. So C plus UT is applicable for Andaman and Nicobar, Ladakh, Lakshadweep, Chandigarh, and finally Daman and Diu and Dadra and Nagar Haveli. Remember, Daman and Diu and Dadra and Nagar Haveli are considered as one union territory. Earlier these were separate, but today these two are considered as one. So if there is a transaction within Daman and Diu and Dadra and Nagar Haveli, there will be a C plus UT implication. Plus, never forget that if the location of supplier and place of supply is in different states or different union territories, then IGST will be applicable. For example, if the transaction is from Andaman and Nicobar to Lakshadweep, the supplier is in Andaman and Nicobar and the place of supply, the consumption is happening in Lakshadweep based on place of supply provision, then Andaman and Nicobar to Lakshadweep, you will be charging IGST. Don't make a mistake of charging C plus UTGST. So only 3 types of taxes can apply till the end of IDT. C plus S, C plus UT and IGST. There is a topic called as compensation cess, but you have only the meaning of it. You don't have that law for your syllabus. Now, coming to the voting power. Central government's voting power is 1/3 and state governments all taken together is 2/3. It's kept 2/3 for a purpose that all states cannot pass a decision ignoring central government, because the main objective of bringing GST was that central government and state government come together to make the law. So the required majority to pass a decision is 75%. So even if all the states come together, they will be able to achieve only 66.67%. That means without central government, decisions cannot be passed in the GST Council. And finally, the required quorum is 50%. This is the majority required to pass a decision. Obviously, what is counted is present and voting. Normally, you have 100% attendance in GST Council because we are talking about monetary terms or revenue. 50% is the quorum. This is not dependent on this 1/3, 2/3. Here it is dependent on the total number of members. While 75% is dependent on this voting power, but 50% is dependent on number of members. Total members in GST Council, 31 here, 2 are there from central government, total 33. So 17 members is the required quorum. Quorum is the minimum attendance for a meeting to be valid. So if a GST Council meeting is held, if less than 17 members are present, then in that case it is not considered as a valid meeting. So this was about the constitutional provisions. Now coming to the registration limits. Though we will see it in registration chapter, but it becomes important to know this at the beginning so that you are able to understand various other topics which are linked to this. Now, registration limit, government has said that if you are only dealing in goods, then in that case there will be 3 limits depending on the state in which you are operating. All these are based on aggregate turnover, and the keyword which we forget in the examination is financial year. Careful, it is not based on preceding financial year. There are some exemption entries which are based on preceding financial year turnover, where you get the exemption if last year turnover was below registration limit. But when it comes to registration limits, the law is very clear that it is based on a financial year's turnover, not based on preceding financial year turnover. So what are the limits? There are three: 40 lakh, 20 lakh, 10 lakh. While for only services, or if a person is dealing in goods plus services, there are only two limits: 20 lakh and 10 lakh. Now, see this carefully. Most of the people who are in business will fall under this category, because most of the goods suppliers might also be providing some service. Most of them will fall under category 2, while category 1 has a restriction that it should be only goods exclusively. 20 lakh is applicable to all other states and union territories. I write all other states and union territories because 10 lakh limit is applicable to 4: Manipur, Tripura, Nagaland and Mizoram. So for these 4, the limit is 10 lakh. These 4 states did not agree for a higher limit of 20 lakh: Manipur, Tripura, Nagaland, Mizoram. Then this 10 lakh also remains same: Manipur, Tripura, Nagaland, Mizoram. But 20 lakh, some states did not agree for 40, which were Meghalaya, Arunachal Pradesh, Sikkim, Telangana, Uttarakhand and finally Puducherry. You can recollect whatever you have learnt earlier, but if you want to remember this, you can remember this by Mast UP. Meghalaya, Arunachal Pradesh, Sikkim, Telangana, Uttarakhand, Puducherry. But if you are recalling this, you should also know the risk associated with this shortcut. M, careful, there are 3 M's totally. Institute can easily confuse you in exam. Meghalaya 20, while Manipur and Mizoram 10. All 3 are from northeast, so be careful on this. Meghalaya. Arunachal Pradesh, when you remember this Mast UP, Arunachal Pradesh is representing A, but you might also think that it is Assam, because Assam is also a northeastern state, so be strong with this. Assam 40 lakh turnover. Sikkim, you will not make a mistake. T, just be careful between Telangana and Tripura. U, Uttarakhand. Obviously there are only 2 states in India which start with U: Uttar Pradesh, Uttarakhand. Uttar Pradesh had to go with 40 lakh. Uttarakhand, small and underdeveloped. All these small and underdeveloped states did not opt for 40 lakh. Puducherry, again a very small union territory which is regarded as a state for the purpose of GST. All other states and union territories have the registration limit as 40 lakh. So this is the registration limit. Now coming to the third aspect, utilization of input tax credit. Now this order of utilizing input tax credit is very much essential for you, because in any computation question this is what you will be using. Now see, there could be 2 types of transactions. One is a inward supply and the second one is a outward supply. In general terms, you call this as purchase and you call this as sale. When you have paid IGST on the inward supply, the law says first use IGST so that you have completely utilized it. However you utilize it, I will transfer that credit to that respective state government and central government as you have utilized and in the manner in which you have utilized. Law has given an order of utilizing input tax credit. The tax which you have paid on purchase, if it is allowed to be adjusted against output tax, then it becomes a ITC. If it can be adjusted against output tax. Are there rules regarding this? Obviously, there's a complete chapter called as input tax credit. So this IGST can be first adjusted against IGST. Then you will use I against C or S, and here the government has said any order, any proportion. So there could be a number of possible solutions. Be careful about this. Now, when you say any order, any proportion, say suppose I have a IGST payable of 100, CGST of 10, SGST 10, and I have a ITC of IGST of 110. How will I use this input tax credit? Government is saying first you use this against IGST, same kind of tax. Then balance 10 you can use in any order, any proportion. The law has left it to your discretion. One methodology could be using half-half. The second methodology could be using against CGST, and the third is also possible where you use it against S. Plus there could be other multiple combinations which you can use, 9-1, 1-9, 8-2, 2-8, various possibilities. So how do we best utilize it? Don't forget one job of yours, to derive minimum tax payable for the client. That is the main objective. So at the end of the day, after doing all this, you should derive minimum tax payable. In this question, you do it as 5 and 5 or 10 and 0 or any other combination. You will still get a payable of 5 CGST, 5 SGST, total being 10. So your total should match the minimum tax payable. Now I'll give you some tricks which you can always use. Whenever the ITC of C and S is equal, careful, output of C and S will always be equal only. I am talking about ITC. If the ITC of C and S is equal, then you can use IGST against C and S half-half. You will get the correct answer. Normally ITC of C and S will also be equal, but there could be some opening balance. And what happens to opening balance? It gets carried forward to the next month. So until and unless they are unequal, please don't worry, use IGST against C and S equally. You will get the correct answer, you will always get the minimum liability. But if ITC of C and S are unequal, that is you have more of C, less of S, then you have to be a bit smart. You first use I with I, then as you already have too much of C, use I against S to that extent or to a possible mathematical extent to derive minimum tax payable. So be careful. If the ITCs are unequal, you have more of CGST input, less of SGST input, then use I against S, because ITC of C will be able to pay output of C. So you need more I to be used against S. Careful. Or it could be a case where ITC of C is less, S is more. Then focus on using I against I first and then I against C. That's how you can always derive minimum tax payable. To conclude, I with I is mandatory, but then the law says any order, any proportion. If the ITC of C and S is equal, no problem at all, use half. If the ITC of C and S is unequal, then be smart. If CGST input is more, use I against S. If SGST input is more, use I against C to derive minimum tax payable. That's our ultimate goal. To the extent they are more or less, try to use it better so that you get minimum tax payable. And ITC can be different of C and S only when there is a opening balance of one particular credit and not the other one, or unequal opening balance of C and S. This is first. Then CGST can be used against CGST and then C will be used against I. Never ever use C with S or S with C. Then S/UT can be used against S/UT or IGST. And wherever we say S, obviously it also means S/UT, because you might do this calculation multiple number of times, but each state and union territory you need to have a separate registration in GST. So for that particular state's computation or that particular union territory's computation, either you will have C plus S combination or you will have C plus UT. You will not have both in a single transaction. So following this order is mandatory. You can't use step B before completing step A. You can't use step C before completing step B. Be very careful. First, utilize I completely. Then you can move on to CGST. Then you can move on to SGST. Following this order, mandatory, you don't have an option. Okay. So this was about utilization of ITC. So first we did constitutional provisions, then we went to registration limits, then we spoke about utilization of input tax credit. Now talking about taxability. You need to know very well that 6 products are outside GST. One is alcoholic liquor for human consumption and 5 petroleum products. Which are those 5 petroleum products? Petrol, also known as motor spirit, high speed diesel, natural gas, aviation turbine fuel, and petroleum crude, that is the basic crude oil. Be very careful. Anything other than these 5 will be liable to GST. Other petroleum products like LPG, base bitumen oil, lubricating oil, furnace oil, all this will be liable to GST. There are only these 5 petroleum products which are outside GST. Plus, what about medicines containing alcohol? Liable. Chocolates containing alcohol? Liable. Because only alcoholic liquor for human consumption is outside GST. Remember these 6. These 6 for your exams are also known as non-taxable supplies. It's a supply which is not leviable to GST. Careful. Non-taxable supplies. We will again deal with non-taxable supplies as we move forward. Then coming to charge. Now, we are talking about GST. But is there some other tax also? Yes, compensation cess, which is collected by central government to compensate the states for any loss of revenue due to introduction of GST. So when GST came, the states were scared that our revenues will fall down. Central government gave a guarantee, first 5 years, if there is any loss, I will compensate. But where will central government get money from? From general public by collecting compensation cess. This is applicable on few products such as tobacco, car, aerated water, that is your Pepsi, Coca-Cola, etc. So compensation cess is exclusively collected by central government. It is extended till 31st March 2026. Till that time compensation cess will be there. Now talking about only GST, charging section. People, section 9 deals with charging section of intrastate supply, that is, it is contained in CGST Act, while section 5 deals with interstate supply, that is IGST Act. Both of these have 5 subsections, 9(1) and there you have 5(1), 9(2), 9(3), 9 subsection 4, and then you have 9 subsection 5. IGST law and CGST law, there are 2 major differences between this 9 and 5. 1. Maximum rate in 9 is 20% and maximum rate in IGST is 40%. It can never go beyond this. That's the constitutional cap in the section, which can be amended by the parliament. Then this deals with intrastate supply and section 5 deals with interstate supply. Now 9(1) says GST will be applicable on all intrastate supplies except alcoholic liquor for human consumption. So if you see carefully, government is excluding alcoholic liquor for human consumption under 9(1). But sir, then what about other 5 products? The other 5 products are excluded based on 9 subsection 2. The law says that GST on 5 petroleum products will be applicable from a later date, to be notified by government. Careful. On the recommendation of GST Council. Be very careful. The recommendation will be given by the GST Council, but the notification will be issued by government. We are reading CGST Act, so it says central government. If it were reading SGST Act, we would have mentioned state government. Now, it also says that the rate of GST will be again notified by central government on the recommendation of GST Council. Then sir, GST is applicable on what? It says value as per section 15. Whatever is the value derived in section 15, on that GST will be applicable. There is no quantity based GST. These are value based GST. On value, you multiply with a rate to get the GST payable. The maximum rate under section 9 is 20%. What would be the maximum rate here? 40. And this deals with intra, this deals with interstate supply. 9(3) gives a power to government to notify goods or services where recipient will pay the tax directly to government. And sir, is this also based on recommendation of GST Council? Obviously yes. Now, is goods there in your syllabus? No. Is services there in your syllabus? Yes. So in a topic when we are revising reverse charge mechanism, I will take you through all the services where recipient is liable to pay GST. Goods, they will have to give you in the question that these goods are covered by RCM. So 9(3) basically deals with recipient paying the tax. You know the name very well. Reverse charge mechanism. Okay. 9(4). 9(4) says supplier and for notified recipients and notified goods or services, twin conditions, plus a case where supplier is unregistered, recipient is registered, then recipient registered person will pay the tax to government. This is also RCM. But in 9(4) there is only one sector which is notified, that is real estate sector. 9(3) has various sectors. 9(4) has only one, which we will deal with in reverse charge mechanism revision as we move forward. 9(5) says there is a supplier, there is a recipient, and the supplier is supplying through e-commerce operator. Be careful. Eco being the supplier, we are not talking about set supply. We are not talking about a supply where e-commerce operator himself is a supplier. We are talking about a transaction where eco is someone different, e-commerce operator is different, supplier is different, and it should be a notified service, not goods. The power is only to notify services. For these notified services, recipient will pay the tax under reverse charge mechanism. Was 9(3) and 9(4). But 9(5), these recipients are generally customers. So government could not say that recipient will pay the tax. Now whom should they catch? They said, e-commerce operator, you are a strong person. Let the e-commerce operator pay the tax directly to government as if he is the supplier. For instance, there is a driver, there is Ola Uber, and there is a customer. Can you shift the liability on the customer to pay under reverse charge mechanism? Like everyone who is traveling through Ola Uber has to register and pay tax. Government said, let me catch the e-commerce operator. Eco will pay the tax as if He is the supplier. Sir, what if the e-commerce operator is not in India? Don't worry. The law says if he is not in India, there will be a representative. That representative has to pay. Sir, if there is no representative, then e-commerce operator has to appoint a person, and that person has to pay GST on behalf of e-commerce operator. So government is very clear. Catching e-commerce operator is very easy for them. Eco has to pay the tax either himself or through representative, or appoint a agent in India and pay tax. If they don't, then we'll block the website under Information Technology Act. Very powerful law, and that's the reason it's easier to catch e-commerce operators. But be very careful. This transportation of passengers, that is driver sector, was unorganized, and hence government was not getting tax from these suppliers. That's the reason government said let e-commerce operator pay the tax. Careful. Only notified services, and there are only 4 services which are notified as on date. One is transportation of passengers. I will show you this in detail after some time when we are discussing RCM and ECO. Transportation of passengers, restaurant service, housekeeping, urban company, hotel accommodation. Basically, make my trip go Ibibo. There are some restrictions and some exceptions which we will deal with when we are revising RCM and ECO. But this was the structure. First, forward charge 9(1), where supplier will collect the tax and pay it to government. 99% cases everything is covered by 9(1). 9(2), sleeping provision, it says 5, let the tax apply on a later date. 9(3), RCM. 9(4) is again reverse charge mechanism. 9(5) is where ECO is responsible to pay the tax. That is the e-commerce operator. We'll again revise these 3 when we come to those specific topics. So this was a brief introduction about charge. Now, first we have completed constitutional provision. Then we did registration limit, utilization. You are able to recall I with I, C or S, any order, any proportion, C with C, C with I, S with S, S with I, 40, 20, 10, only goods, must UP, MT and M, Manipur, Tripura, Nagaland, Mizoram. Then type of GST, C plus S, C plus UTI, GST, 279A GST Council. Voting power of central government 1/3, voting power of state government 2/3, required majority 75%. Then we did 9(1) to 9(5), and now we are going to take up supply. Now this will be very useful in valuation questions, input tax credit questions, MCQs, very relevant. Now, so section 7 deals with supply. Sir, can I use only section 7 in entire thing? The answer is yes. Do I have to remember the subsections? If you recall, very good. If you don't, then you can use section 7, no problem at all. So section 7 of CGST Act deals with supply. First, let's understand some basics. If 3 conditions are satisfied, then it will be regarded as a supply under section 7 and hence liable to GST, because entire ambit is based on supply. GST is applicable when there is a supply for consideration in the course or furtherance of business. In the course or furtherance of business. So three critical aspects: supply, consideration, in the course or furtherance of business. So whenever the supply is for consideration and in the course of furtherance of business, it gets covered under section 7. That means GST would be applicable on this transaction, because entire charging section talks about interstate supply, intrastate supply, and supply is defined in section 7. Government has not defined supply as such here. It says supply such as. They have given some examples: sale, barter, exchange, transfer, lease, license, rental, disposal. These are the examples given in the law. Then the law says consideration can be monetary, non-monetary, or act or forbearance. Agreeing to do something or agreeing not to do something, both are considered as consideration for a supply. I agree not to compete against you, supply. Don't forget, there is a difference between tolerating an act and there is a difference between agreeing to basically breach of contract. If, say, suppose I agree that you don't do something and we enter into a positive agreement regarding that, then GST will be applicable. But if there is a breach of contract, that is, you don't do something and because of that I earn liquidated damages or penalty, that breach of contract is never regarded as supply for consideration. This is clarified by CBIC in the circular, saying that breach of contract, liquidated damages, is not the primary intention of the contract, and hence there is no supply for consideration in case of breach of contract. So GST will not be applicable on breach of contract. Getting a penalty, getting a liquidated damage will not be liable to GST. Coming to deposits. Is GST applicable on deposits? The answer is no. But if deposit is applied as consideration, like say suppose I took a 10-month deposit for giving a property on rent, that deposit is not liable. But if the other person is not paying rent, I will adjust the deposit, then it becomes consideration. What about advance, sir? Yes, advance is liable to GST. But obviously the timing might differ. Sometimes advance is liable the moment you receive it. Sometimes it is liable when the invoice is raised, depending on whether it is for goods or service, which we will see in time of supply revision. Government subsidy is not consideration at all. There cannot be any GST on government subsidy. Like there was a circular by CBIC saying that RuPay cards, to encourage RuPay cards, government is giving a subsidy. Should GST apply on the incentive or subsidy which government is giving to the banks for encouraging RuPay cards? CBIC clarified that GST will not be applicable because government subsidy is not consideration. Then other subsidy. If anyone else is giving a subsidy, whether GST will apply? The answer is yes. Otherwise, each one will start giving subsidy to the other person and never will GST apply. Any subsidy other than government is liable to GST. Okay. What about local authority, BBMP, or basically municipality giving any subsidy? GST is applicable because here the law only excludes government subsidy. Careful, you'll find only government subsidy written. Then the definition of business is very wide. I mean, it tries to cover as many things as possible. It says trade, manufacture, profession, vocation, that is some dance classes, skill development classes, those are also covered. Adventure could be a one time or a non-recurring activity with a profit motive. Again, it's considered as business. But if it is sale of personal assets, then GST will not be applicable. Admission is basically entry fee being paid. Holder of an office, that is holding a position, if you are holding a position and you are getting something for that, again it is business. Then central government, state government, local authorities discharging their functions as public authorities. We don't leave even government is also said to be carrying on business. Association to members, association is said to be carrying business. In fact, any supply during closure of business is also regarded as business. What about horse race clubs? Yeah. What about wager transactions? Sir, illegal na, doesn't matter. Taxation never differentiates between legal and illegal. All these will be liable to GST. Now, see, association to members, it is business. But are they two different persons? This thing reached Supreme Court in service tax, and Supreme Court in the judgment of Calcutta Club said that association and members are one and the same. There cannot be service tax on them. Government got into action and immediately amended the GST law to provide that a person other than individual and its constituents, a person other than individual and its constituents or members, that is those who have made it, are deemed to be different persons, and any supply between them would be liable to GST. So association and members are different. By this particular sentence, government also tries to say that even if there is a partnership firm and partner, those two will also be regarded as different, because a person other than individual can cover partnership firm, constituents. Who makes a partnership firm? Partnership firm and partners, as per Indian Partnership Act, they are same, but for GST they are different. So if there is a transaction between them, whether GST will be applicable? The answer is yes, GST would be applicable. Then can there be some exceptions? Like, say suppose it is not in the course or furtherance of business, can GST apply? There is only one transaction, import of service. But remember, in this, consideration should be there. There is only one transaction where GST can apply even when consideration is missing. Then can GST apply where consideration is missing? So here business was missing. It should not, even if it is not in the course of furtherance of business, GST will apply. Can there be a case where consideration is missing and still GST applies? But sir, on what value? Value will be open market value. That is the price at which you normally sell it to a unrelated person, where price is the sole consideration. Where consideration is missing, there are totally 4 transactions covered. First one, permanent transfer of a business asset where ITC was availed. So if you have availed ITC on a business asset and then you give it free of cost, government is like, this is cheating. I gave you ITC so that you use it for your business and you are giving it free of cost. This is not allowed. I need GST on that. Second one is transaction between related person and distinct person. So if you give something free of cost to your relative, government is like, I need GST on that. Distinct person is branches which are registered separately. It could be within the same state or outside the state, anyways they have to register separately. So distinct persons, GST will be applicable. So related person. Related person is basically partners, employer-employee, directors in one another's business, one controlling another, two controlling one, one controlling two, holding 25% or more voting rights in 2 companies. Family. What is family, sir? Spouse plus children plus dependent grandparents, parents, brother, sister. Careful. Spouse and children are always related, but grandparents, parents, brother, sister are related only if they are wholly or completely dependent on this person. Only then they are considered as related. Then if you have a sole agent, only one agent, or sole distributor or sole contractor, that is a concessionaire, then in that case again it is considered as a related person. Then you have import of service. Now this import of service is without consideration. This was with consideration, where it was not in the course of furtherance of business. This import of service is without consideration. From a related person or establishment, that is a branch outside India, in the course of business. Careful. It should be from a related person in the course of business. Twin conditions. From a related person in the course of business. So be very careful. If import of service is with consideration, don't worry at all. If it is without consideration, then business should be there, plus it should be from a related person. And the last one is principal and agent transaction, where billing is in the name of agent. Which billing, sir? Billing to end customer. See, what does an agent do? He helps to either sell principal's product or purchase on behalf of the principal. When he is trying to sell, he is trying to sell to someone, na? If the agent is billing to the customer, then the transaction between principal and agent is without consideration, because principal cannot charge for the goods from the agent. So in that case, principal will charge GST to agent, agent will charge to customer. But this is possible only when agent is billing directly to the customer, and this is only for goods, not for services. So careful. Principal and agent, it is regarded as liable to GST if billing is in the name of the agent to the customer. Okay, this is called as schedule 1, supply without consideration. But don't forget, supply without consideration does not mean that business is also missing. Supply without consideration should be in the course or furtherance of business. Okay, so first we learned 3 important conditions. Then we learned that business could be missing in one place. Then we learned that consideration could be missing in 4 places. Then we also learned about members and association, which are deemed to be different persons, notwithstanding any judgment, any other law. They will be regarded as different. GST will be applicable. This was schedule 1. Schedule 2 is fairly simple. Schedule 2 deals with classification. It says transfer of title. Whenever ownership is getting transferred, the transaction will be regarded as supply of goods. Whenever right to use is getting transferred, that is, you are allowing it for a particular period of time, then it will be regarded as a service. So ownership getting transferred, supply of goods. Right getting transferred, supply of service. This is the basic criteria which you need to remember to crack any case of schedule 2 classification. Then you have schedule 3, which deals with negative list. These are transactions which are not liable to GST. It's neither supply of goods nor supply of service. But before I tell you about negative list, you should remember money and securities are neither goods nor services. Neither goods nor services. But what about a fee, commission, brokerage charged for money or dealing in securities, then fee or commission or lending fee charged? That all will be liable. Purchase and sale of shares or securities, no GST. Commission, brokerage, etc. liable to GST. Exchange of money, no GST. Commission, brokerage, it's a supply of service liable to GST. Now, coming to negative list. First, immovable property. Sale of immovable property. Now, government has said that if the immovable property is under construction, then GST will be applicable. And here we are talking about a building, because land anyways doesn't matter. Even if land is being sold after being cut into smaller blocks, still sale of land is a sale of immovable property per se, covered by negative list directly. Building under construction, GST is applicable, because builder is providing you a service of constructing that particular flat or floor for you. Constructed property, there is no GST applicable, because it's again a immovable property per se. Then the law says actionable claim. Other than. Oh, so actionable claim, no GST, but other than betting, gambling, lottery. See, betting, gambling, lottery are liable to GST. Actionable claim otherwise, no GST, but betting, gambling, lottery will be liable to GST. Then we talk about 2 goods transactions which are not liable. One is sale of warehoused goods or high sea sale. Now both we will again revise in customs. Sale of warehoused goods, try to recall. Goods are there in the warehouse. You imported it from US. Goods are there in the warehouse. And you sell it while they are in the warehouse, you have still not paid custom duty. Then in that case, the other person will pay custom duty. He will be discharging IGST. So the sale between you and him is covered by negative list. This is to avoid double taxation. High C sale is even before that. Like goods are yet to come. Ship has left US. Now you find a customer. You sell those goods even before they have come. The other person will file bill of entry and pay custom duty. The transaction of sale between you and the other person is covered by negative list. So warehouse goods is where the goods have come into the warehouse in India. High C sale is even before the goods have come to India. Second one is goods from non-taxable territory to non-taxable territory. So from one non-taxable territory to another non-taxable territory without entering India. Like I am sitting in Bangalore. I got an order from Sri Lanka customer. I ordered it from China and said, China, you directly deliver to Sri Lanka. Did the goods come into India? No. Government has said this transaction is also covered by negative list. Okay. Then the law says employee providing service to employer in the course of employment. In the course of employment. Careful. If it is part of employment contract, employee getting anything from the employer, no GST. Food, canteen, transportation, part of employment contract. Otherwise, GST would be applicable. So, employee providing any service to employer in the course of employment will enjoy a exemption. Will be covered by negative list. Careful. Employee to employer is covered. If employer is providing, say suppose he is a manufacturer of shirt, he sells that shirt to employee, then GST will be applicable. Both are related parties also. But sir, what about Diwali gift etc.? Government has said gift up to 50,000 per employee in the entire financial year will not be supply of goods or supply of service. This is a relief which is given. Then sir, then fees taken by court or tribunal. Again covered by negative list. Members of parliament, member of state legislature, that is MLAs, or member of panchayats, municipalities are also covered by negative list. Constitutional persons, President of India, head of CAG, these persons are also covered by negative list. And any member or chairperson of a body established by central government, state government, local authority. This can cover your SEBI, IRDA, or we keep framing committees in India. So all those committee members. Then you have funeral, burial, crematorium, mortuary. Crematorium, mortuary, remember these two important terms, including transportation of deceased. Then alcoholic liquor license. Careful. We are talking about the liquor license. And lastly, panchayat. For a function which is interested in Article 243G of the Constitution, if they are charging something for that, say suppose garbage collection charges, function interested in the Constitution will enjoy a negative list relief. Now how can you remember this? I'll just add M so that you can remember it easily. Image, FMCM, Finance Minister, Chief Minister, both not liable, FAP. This is how you can easily remember negative list. Immobile property, M ignore, A actionable claim other than betting, gambling, lottery. G 2 transactions. E employee providing services to employer. Fees taken by court or tribunal. MPMLS constitutional persons, member of body established by central government, state government. Funeral, alcoholic liquor license, panchayat. Okay, so this was about schedule 1, schedule 2, schedule 3. The last topic in this is section 8, composite and mix supply. Very useful in solving various questions of computation. Composite supply, don't confuse composite and composition. A composition is a scheme, composite is a type of supply. Don't mix these two. Composite supply is 2 or more goods or services supplied in conjunction. Conjunction meaning together, where one is a principal supply and it is naturally bundled in the ordinary course of business, like accommodation with free breakfast, laptop with warranty, or it could be a case where AC is being sold and installation is being given. Remember that if composite supply 4 conditions are satisfied, then the rate of GST which will apply will be the rate of GST of the principal supply. Whatever is the principal supply, that rate will be applicable. But if the conditions are not satisfied, then have a look at mixed supply also. 2 or more goods or services. Here also it is supplied in conjunction. What is conjunction, sir? Together. As a package. None is principal. The law says it is not a composite supply. That means you are not able to identify which is the principal. Single price. Then in that case, the rate of GST which will apply will be the highest rate. Careful. Single price, not single invoice. Single price. In one invoice, there could be multiple things. That's not a mixed supply. There individual prices are given, separate GST rates will be applicable. Here we are talking about single price. Careful, composite supply does not have single price condition. That means in composite, if it is supplied in conjunction, even if the prices are given separately, still it will be regarded as a composite supply. Like packing charges given separately, installation given separately, transportation given separately, still it will be considered as composite supply. Rate of GST of the principal supply will be applicable. There could be a case where it is neither composite nor mixed supply. Be careful about those transactions where separate values are given and one bill is raised, like in a supermarket where you purchase 20 products, one bill. Then in that case it will be neither composite nor mixed supply. Individual GST rate for product will be applicable. So this was about introduction and supply. Quickly recalling everything. First we started with constitutional provisions. Then we went to registration limit, then utilization of ITC, then taxability of various products, charge, section 9 and section 5, supply, and we concluded with composite and mixed supply. Try to recall this quickly You can pause the video here and recollect all of this for next 5-10 minutes. Now let's talk about time of supply. See, time of supply, you basically have section 12 which deals with time of supply for goods, and section 13 which deals with time of supply for services. And then you have section 31 which provides the due date to issue invoice. So we compare the due date to issue invoice versus the date of invoice to get the time of supply normally. But it can vary depending on forward, reverse, continuous supply, vouchers, interest, any other case. And you also have section 14 which deals with change in rate of tax. Say suppose there is a change in rate of tax, then how do you determine the time of supply and how do you determine the rate which will apply? First let's complete 12 and 13, then we'll talk about 14. For goods, now there could be a case of forward charge, there would be a case of reverse charge, and the third case is continuous supply. Even for services, there can be a case of forward charge, reverse charge mechanism, and continuous supply. What has the law said? Forward charge, it would be date of invoice or due date to issue invoice, whichever is earlier. Remember, date of payment is not used as time of supply for goods forward charge, but there is an exception, composition scheme. Composition scheme, is date of payment used for time of supply? The answer is yes. In composition scheme we'll be using date of payment even for goods. So there it would be date of payment or date of invoice, whichever is earlier. This date of payment was deleted based on notification number 66/2017, but it excluded composition scheme. So composition scheme, even today date of payment is relevant. This due date to issue invoice, if the supply involves movement, then it will be date of removal date. If the supply does not involve movement, then it will be date of making available. And if it is a case of sale on approval basis, it will be acceptance / 6 months from the date of removal. Acceptance or 6 months from the date of removal. That's the time limit which is given to raise a invoice. And then you'll compare it with date of invoice. Whichever is earlier will be the time of supply. RCM, the law has said 31st day from invoice or DOP or receipt of goods, and obviously whichever is earlier is there. Continuous supply, again date of invoice or date of payment, whichever is earlier. This date of payment or statement is coming from due date to issue invoice, because due date to issue invoice for continuous supply of goods has date of payment or statement. Statement is basically quantity details of the product which is being supplied. Now continuous supply of goods, I can give you an example. Gas being supplied on a continuous basis through a pipeline, kerosene through a pipeline, All these will be cases of continuous supply of goods, because the characteristic of goods does not change even if it is being supplied through a pipeline. Coming to services. Forward charge, government has said, check whether the invoice is issued within 30 days from date of provision of service or date of completion of service, when the service was provided. If it is issued within 30 days, then you will compare invoice or payment, whichever is earlier is there always. If it is not issued within 30 days from completion, then in that case you'll use date of completion or date of payment, whichever is earlier. So the law brings in completion only when you have not issued the invoice within 30 days from the date of provision of service or completion of service. Careful, 30 days is replaced by 45 days. Banks, financial institution, insurance companies. Now some important points for forward charge. What is the definition of date of payment, which we have mentioned time and again? Date of payment differs between forward and reverse. Forward charge, it is date of entry in the books of supplier or credit in bank of supplier, whichever is earlier. But for reverse charge, it will be date of entry in the books of recipient, because reverse charge you are looking from the angle of recipient, not from the angle of supplier. So be careful on that particular thing. Or debit from bank of recipient. So forward charge will be from the angle of supplier, because obviously forward charge is from the angle of supplier. Reverse charge, it will be from the angle of recipient. Here RCM, government has said 61st day from invoice or payment date, and obviously whichever is earlier. Careful, here 61, here 31. In the exam, don't get confused. Easy to remember. Goods, smaller word, 31st day. Service, bigger word, 61st day. Continuous supply, government has said invoice or payment or due date to issue invoice. Now this due date to issue invoice can be of three types. One, where the payment date is ascertainable from the contract. Say suppose contract says 5th of every month you have to pay 2 lakh. Then that 5th becomes the due date to issue invoice. That is when the payment date is ascertainable from the contract. If payment date is based on completion, then completion of each event. Like first floor will pay you 5 lakh. Then that 5 lakh first floor, the date of completion of first floor becomes the due date to issue invoice. And if payment date is not ascertainable, then date of payment will be used. Then comes interest. Interest, time of supply, is same for goods as well as services. But remember, if there is a interest related question for goods, mention 12. If there is a service related question, then mention 13, because these provisions are repeated for both 12 as well as 13. Interest, the time of supply, is when such interest is received by supplier. The moment it is received by the supplier, that will be the time of supply. Now interest, which interest are we talking about? Interest on delayed payment of consideration for a taxable supply. The underlying supply is taxable, on that you receive interest, then it will be time of supply will be this. Sometimes it may be called as late payment charges, penalty, late fee. All these terminologies will not matter. Whether it is for delayed payment of consideration for a taxable supply, then this will be the time of supply for such interest. You know, any other interest normally is exempt from GST. While revising exemption, I'll tell you about it. Then vouchers. Remember, that the taxability is not on voucher, the taxability is on underlying goods or services. So voucher, if it is identifiable meaning it can be used only against a particular goods or service. If it is identifiable, then time of supply will be date of issue of voucher, because it can be used only against a particular goods or service. You know which goods or service you can purchase from that, so the day the voucher is issued, that will be the time of supply. Non-identifiable voucher is a voucher which can be used against a variety of goods or services. For that, government has said time of supply will be date of redemption, because as on date I don't know what will be the purpose for which you are going to use this voucher. Then the law says any other case. Say suppose you are not able to find anything, then how will you determine time of supply? Now, if the other person is a registered person, that means he is required to file periodical GST returns, then due date for periodical returns, that will be the time of supply. And if he is an unregistered person, that is any other case, then in that case date of payment of GST, the day GST is paid, that itself will be regarded as time of supply. Now some other key points. 30 days is replaced by 45 days. In case of banks, financial institution, insurance company, you get higher time limit to issue invoice. If you are not able to determine time of supply in any step before any other case, most of the provisions have use entry in the books of recipient. Then associated enterprise. Associated enterprise is again a case of reverse charge mechanism, where there is a branch outside India providing service to another branch in India. Then for associated enterprise, sometimes you might not issue an invoice. So government has said date of payment or entry in the books of recipient, whichever is earlier. So careful about associated enterprise. Then the law says if there are part payments received, there will be multiple time of supply. If there is a excess payment, this is for forward charge only. If there is a excess payment of up to rupees 1000 over and above the invoice, like telecom industry, the bill came to 100 rupees, you paid 105. If there is a excess payment of up to 1000 rupees over and above the invoice, then the time of supply for such excess payment will be next invoice date at the option of the supplier. So for that 5 rupees excess payment, the time of supply will not be the day you receive that 5 rupees. It can be next invoice date at the option of the supplier. But sir, if I want to pay based on date of payment, you can do that. Government is giving you an option that for this extra 5 rupees, as there is an excess payment up to rupees 1000, the time of supply can be either the day you receive this payment or next invoice date. That is when you are going to adjust this amount, because that's what is going to happen at the option of supplier. This is for excess payment. And then the last topic in this is section 14, change in rate of tax. Say suppose there is a change in rate of tax. Now there are three things: date of completion or date of removal. Can I take it as date of supply? The day supply is made. Invoice date, payment date. Now there could be a circumstance where this supply has happened before the change in rate. That time the rate was 12%. Now the rate has changed to 18%. Invoice was also before the change, but payment is received after the change. Then the question is, which rate will apply and what will be the time of supply? The answer for this is given in section 14, which says that if two events are before, then the before rate will be applicable and time of supply will be based on invoice or payment depending on rate matching the date. The only exception to this is goods, because in goods date of payment is not used as time of supply based on notification number 66/2017, which also mentioned section 14. So in that case, time of supply for goods will always be date of invoice, so there could be a mismatch between rate and date. Otherwise it will always be a case where date has to match the rate. I will show you all the cases. Say suppose supply is before the change in rate of tax. This was also before invoice and payment was after. Then which rate will apply? Two events are before, so 12% will be applicable because 12 changed to 18. Time of supply before rate has to match the rate. So if rate is 12 here, then invoice will be considered. Now say suppose this was after. I am keeping this supply one as constant before, and this was before. Then see, again two events are before, 12% will apply and the time of supply will be date of payment. Now what if both are after? See, this is before the change, this is after, this is after. Then rate will be 18% and time of supply will be invoice or payment, whichever is earlier. Clear? Okay. Then the supply can be after the change. Remember, after will always cover on the change date, because say suppose the rate has changed from 1st October, then first is considered after only, because after rate will be applicable. So if this is after and this is before, this is after, then after rate will apply because two events are after, so 18% will apply. Time of supply will be payment date because the date has to match with the rate. If this is after and this is before, then again two events are after, 18%, and this will be date of invoice. Sir, if both are before? If both are before, then 12% will apply, then here it will be invoice or payment, whichever is earlier. That's it. Sir, what if this is after, this is also after, this is also after? If all the three events are on one side, then it is not a case of section 14, because then it's not a case of change in rate of tax. In that case, we will just go by the normal provisions. Don't forget, section 14 overrides 12 and 13. That means if there is a change in rate, that is one event is this side, one event is after the change, then in that case you have to apply section 14 because it overrides 12 and 13. Clear? Okay. Law has also said that if date of payment is after 4 working days from change in rate, sorry, 1 minute. If date of payment is now, if credit in bank is after 4 working days from change in rate, then date of payment equals to credit in bank. That means we will ignore entry in books and date of payment will be the date when it is credited. Because 4 working days, is it a good time limit given for passage of checks? Yes, that is a good time limit given. So say suppose someone wants to show date of payment before so that he can get a before rate, then government is like, don't plan it, because see, date of payment is entry in books or credit in bank. Which is in your control? Entry in books. You might plan a transaction, and that's why government has clearly said date of payment will be credit in bank if the credit is after 4 working days. That means you have done some planning as per government, and hence we will ignore entry date in your books. We will take date of payment as credit in bank only. Go through this entire segment for next 5 minutes. Now let's do a very important topic, place of supply. Place of supply, entire provisions are given in IGST Act 2017. Place of supply deals with consumption. The law has defined where is the goods or services consumed. Now, Section 7 of IGST Act deals with interstate supply. It says when the location of supplier and place of supply are in different states or different union territories, then it will be an interstate supply. There are 3 transactions which are always regarded as interstate supply, irrespective of where the supplier is and where the place of supply is. First one is supply to or by SEZ unit or developer. Unit is the business unit setup. Developer is the person who has made that particular SEZ, that is builder. Then the second one is where the recipient is outside India and the place of supply is outside India and supplier is in India. Basically we are talking about a export transaction. Again, it will be regarded as a interstate supply. Third, not an intrastate supply and the consumption is in taxable territory. Taxable territory meaning India. The example for this can be imports. Import, it is not an intrastate supply because location of supplier and place of supply is not in the same state. So it's not a intrastate supply. So it will be a interstate supply. So 3 transactions are always regarded as interstate supply. SEZ, be very careful. Even if it is within the same state, you will still regard it as interstate supply, and IGST would be the applicable tax if at all it is to be charged. Then we have section 8 which will deal with intrastate supply. Here the law says when the location of supplier and place of supply is in the same state or union territory, then we call it as intrastate supply. Section 9 deals with territorial waters. What does this say, sir? Say suppose the location of supplier or place of supply is coming in waters, then can you keep it in waters? The answer is no. The law says these two, if they are in territorial waters, then the location of supplier or place of supply will be in the nearest coastal state. Say suppose a repair of a ship which is near Kerala coast has been done, then is the repair consumption in territorial waters or Kerala? Kerala, because you'll bring it to the nearest coastal state. Even if some supplier is doing some drilling activity in waters, still it will not be regarded that the supplier is in waters. Supplier will be in the nearest coastal state. Okay. Then we have section 10, which deals with place of supply goods domestic transaction. Careful. Here onwards, place of supply begins. Don't forget. Here only we are determining place of supply. What is the use of this place of supply, sir? This will be used here to compare with supplier's location and determine which type of tax. This will be used here to check with supplier's location and determine the type of tax. That's how it flows. First determine place of supply, then determine location of supplier. If both are in the same state, C plus S. Same union territory, C plus UT. Different state, different union territory, IGST. Section 10 deals with goods domestic transaction. 11 deals with goods international transaction, that is import and export. Section 12 deals with services domestic, and section 13 deals with services international. Now careful, 12 deals with services domestic, but it can be used only when supplier and recipient are in India. Careful, not place of supply. Here you compare two things, location of supplier, place of supply. Here supplier and recipient are in India. Then only you can use section 12. And section 13, supplier or recipient is outside India. Either one is outside India or both are outside India. Then you use section 13. Okay. There is also section 14, which provides for OIDAR service. How do they register and what are the formalities? What is OIDAR, sir? Online Information Database Access Retrieval Services. So Facebook ads, Google ads, cloud services, all this will be covered under OIDAR service. Now first we will take up 13, then we will take up 12, then 11, then 10. And while discussing 13, we will complete 14 as well. Now let's see section 13. When do you use this and what do you get from this? Section 13, we derive place of supply. When do you use it? When supplier or recipient is outside India. Only then you can use it. This is given in 13.1. Then 13.2. 13.2 says generally if something is not covered in any other point, then you can use this generally point. Generally, the place of supply will be location of recipient. Wherever the recipient is, that would be the place of supply. And that is true in all cases. Wherever recipient is, that will be the consumption. Remember, you can use 13.2 only if it is not a specific case covered in anything else. So everything else is stronger than 13.2. It also says that if location of recipient is not collected in the ordinary course of business, then the place of supply will be location of supplier. If the data of location of recipient is not collected, then it will be location of supplier. Now see carefully, if place of supply becomes location of supplier, then it will always be a C plus S transaction. Because what are the two things which you compare to get type of tax? Location of supplier and place of supply. If place of supply is equal to location of supplier, automatically you will charge C plus S. I'll give you an example. HDFC Bank does a demand draft for a person whose address is not taken by HDFC Bank. then in that case, as the ordinary course of business principle, you don't take it. For account holders, you have the address, but for non-account holders who have just come for demand draft, you don't have their address. Then in that case, what will be the place of supply? Location of HDFC Bank. Okay. Then 13.3 deals with performance-based services. Now, performance-based services, the law has said, if it is related to goods, then in that case, check whether it is through electronic means or it is through other means. If it is through electronic means, then location of the goods. Wherever the goods were located, that will be the place of supply. But remember, 13.3 is applicable when recipient gives the goods to the supplier and supplier works on it. For example, dry cleaning. Recipient gives the clothes to the supplier, supplier works on it. Reverse is not true. Say suppose supplier is giving a vehicle on hire, then supplier is giving this. That is not performance based. Performance based where goods are made available to the supplier by the recipient. If it is by other means, then in that case wherever it is performed, like wherever those dry cleaning was done. Sir, can you give us an example for electronic means? Now, say suppose there is a supplier sitting in US. I am sitting in Bangalore and my system in Bangalore requires some modification. So the supplier sitting in US using any of the softwares takes access of my system in Bangalore and repairs it. He is in US, system is in Bangalore. He has repaired it through electronic means. What will be the place of supply? Location of the goods, that is Bangalore. Then if performance is for individuals like makeup, beauty treatment, healthcare service, where recipient or the person on behalf of recipient is on whom the service is performed, then in that case the law again says where the service is performed. Now remember one thing, for goods, if goods are not put to use in India plus they are re-exported, so you re-export them without being put to use in India, then the place of supply will not be as per 13.3, it will be as per 13.2, because if you exclude it from 13.3, it will fall under generally. I'll give you an example. Say suppose diamonds are sent from Russia to Surat in India for polishing, and then we return those diamonds to Russia. Now the polishing was done in India, place of supply will be India, GST will be applicable then in that case. Now if you start charging GST to that Russian person, it will lead to a circumstance where Indian exports will be hit, because for Russia 18% will become a cost, they will not get input tax credit. So government has said, if those goods are not put to use in India, diamonds are just polished and sent outside India, then in that case 13.3 will not apply. You don't have to check where it is performed. Place of supply will be 13.2, that is location of recipient. And in our diamond example, where is the recipient? Russia. We will start getting export benefits. Then 13.4 deals with immovable property. The place of supply for immovable property will be location of the property, where the property is located or intended to be located, or intended to be located. Sir, why intended to be located? Because say suppose construction service is being provided, then the property is not yet there, but it is intended to come up at that particular place, and hence the law has been considerate about this fact to mention that for immovable property, place of supply will be where the property is located or intended to be located. Then we deal with 13.5, that is events. Place of supply for events will be where the event is held. People, this is for admission as well as organization of an event. Admission meaning, sir? Admission is entry fee. Organization related services is that event management services. For both, the place of supply will be where the event is held. Then we have 13.6. If the place of supply is in more than one place, including one place in the taxable territory, like the consumption or place of supply is in India, Sri Lanka, China, then the law has said place of supply for such contracts will be location in the taxable territory. That means we'll bring the entire contract in India, place of supply will be India. So in real life, do we face this situation? No. We enter into different contract for different regions so that this 13.6 does not trouble us. If you enter into bike repair contract or bike testing contract in India and Sri Lanka, then in that case, place of supply for entire transaction will be India. But if you enter into two separate contracts, one for India bike testing and one for Sri Lanka bike testing, then in that case, the bikes which are tested in Sri Lanka, place of supply will be Sri Lanka. The bikes which are tested in India, place of supply will be India. But if there is one contract, then place of supply for entire contract will be in the taxable territory. 13.7. If it is in more than one state, how do you divide it? See, if it is in more than one place including taxable territory, then first we bring it to India. But if it is in more than one state, then the law says the place of supply will be in each state. So to each state, the consumption will be divided. That's what the law clearly mentions. Be very careful that each state or union territory, there are various methodologies prescribed. Based on those methodologies, you determine the place of supply in each state or union territory. Then we have 13.8, that is intermediary. Agents, banking services, and hiring of a means of transport up to 1 month of a means of transport and not anything else like vehicles other than aircraft / vessel, but including yacht. Yacht is covered, but aircraft and vessel are not covered in this. Now, the place of supply for these three will be location of the supplier. Now, whenever we say the place of supply is location of the supplier, what is the implication? If the location of supplier and place of supply are in the same state or union territory, then in that case, it will be a transaction of intrastate will be liable to C+S. There is a Bombay High Court judgment saying that if it's a case of section 13 for intermediary, then in that case only IGST law should apply. But at present, institute has not kept it in your module, so you will go by location of supplier, place of supply. If both are in the same state or union territory, then in that case you will regard it as C+S transaction intrastate. Intermediary. How do you define intermediary? Intermediary for goods or services or securities, but not for immobile property. Yeah? Immobile property will fall under 13.4, not under 13.8. Intermediary is one who just facilitates the transaction between supplier and recipient. So there has to be a supply between supplier and recipient. Intermediary is only helping to get that executed, and hence he is charging a commission or fee for that. Then in that case, we will be deriving the place of supply based on location of supplier, because intermediary is expert in the place where he is, and that's why if the intermediary is in India, government says the place of supply is also in India. But what about BPO services, business process outsourcing? What happens in BPO services? Basically, the business process outsourcing service is a case where there is a supplier, there is a recipient. The supplier in India attends the calls of the customers of the recipients. In that case, he is not acting as an intermediary because he is providing the service on his own account. This is not a case of intermediary services. This is a direct case of supply being made by the supplier to the customer for and on behalf of the recipient. So intermediary is someone who does not provide the service on his own account. Clear? Okay, this is a very good CBIC circular. We need to be very careful. Brings out the same point which I just told. Sir, what if hiring of means of transport is more than 1 month? Then it will fall under 13.2. What about aircraft or vessel? Again it will fall under 13.2. Then 13.9 we have transportation of goods. Transportation of goods, it says other than mail or courier. That means mail or courier will fall under 13.2. Transportation of goods, the place of supply will be destination. Careful. In transportation sector, now be very careful. Who is the supplier? Transporter. Who is the recipient? Person liable to pay consideration. Whoever is the person liable to pay consideration, it could be the consignor or consignee. Whoever is paying the consideration, he will be regarded as the recipient. 13.10 deals with transportation of passengers, and the place of supply will be where the person embarks for a continuous journey. What is continuous journey, sir? Without any stopover. That means you are not allowed to step out of the aircraft even if it is landing at some other airport for an intermediate flight. Like if there is a Delhi Mumbai Bangalore flight, Delhi Mumbai Bangalore, if you have taken a Delhi Bangalore ticket, you cannot get down at Mumbai. That's a continuous journey without any stopover. But say suppose you take Delhi Mumbai Bangalore, but you have to change flight in Mumbai, then in that case they will be regarded as two separate journeys. But sir, how will it be a case of section 13? Because Delhi, Mumbai, Bangalore, everything is in India. No. See, there could be a person who is US resident. Even if one of them is outside India, then the place of supply is determined as per section 13. When to use it, you need to be very smart. Check supplier, recipient. One of them should be outside India for 13 to trigger. Otherwise, it will be a case of section 12. Then we have 13.11 on-board services. Services supplied on board of a conveyance. On-board services, the place of supply will be first scheduled departure point. First scheduled departure point of the conveyance, wherever the conveyance started. Say suppose conveyance started from Delhi, then the place of supply for Delhi, Mumbai, Bangalore, the place of supply for on-board services which are provided on board of the conveyance will be Delhi. 13.12 OIDAR service, online information database retrieval services. Location of the recipient. Why has government used location of recipient here? Careful. Even 13.2 says location of recipient. But if that is not available in the ordinary course, then you can use location of supplier also, right? 13.12 does not have an option to use location of supplier. For OIDR service, it has to be location of recipient. That means if Facebook is providing service from outside India entity to a recipient in India, place of supply will be India. If the consumers are from India, let the tax also flow to Indian government. Now, OIDR service, government has said something. If it is a B2B transaction, then in that case recipient will pay the tax. This is mentioned in section 14. If it is B2C transaction, then in that case the supplier has to register in India and pay taxes. Is it, sir? Yeah. Supplier outside India has to register in India and pay taxes. There is no other alternative available. Is it, sir? Yes. Even if he is outside India person, he has to take registration in India and pay the taxes. This B2C, this consumer is defined in the law. Consumer means any person using it for a purpose other than business, plus includes government, because obviously government will not pay tax under RCM, because here if it is a B2B transaction, then recipient will end up paying tax in RCM, because Facebook outside India, recipient JK Shah classes in India, JK Shah classes will have to pay the tax. If it's a B2C transaction, supplier will pay the tax even if he is outside India. Sir, what if he does not have physical presence? Appoint a representative or appoint an agent in India to pay the taxes. How do we get to know that the consumer is in India? How do we get to know that? Government has said, check credit card, debit card, fixed line, address, billing address. Out of all these, if 2 factors are in India, then it is deemed that the consumer is of India. At least 2 factors. And address, billing address, if the person is saying I am from India, automatically it will become from India. Plus mobile number of India, again 2 conditions out of 6. 1, credit card, debit card, fixed line, phone number. Then you have the address, and finally billing address. If out of these 6 at least 2 factors are in India, then it is deemed that the consumer is of India. 1313 gives a special power to government where they can define the place of supply, where some double taxation is happening or non-taxation is happening. Government has used this to define that for research and development in pharma sector, the place of supply will be location of recipient. Even if the research and development is done in India, still the place of supply will be location of recipient. Then vessel or aircraft maintenance, repair, overhaul for business purpose, again it will be location of recipient. Basically I am a airline operator or I am a vessel operator and I get maintenance, repair, overhaul of that vessel done in India or aircraft done in India, then the place of supply will be location of the recipient, not where the repair was carried out. So this is about section 13. Section 13, what did we learn? Generally it will be location of the recipient. If that is not available in the ordinary course of business, then use location of the supplier. Performance based service, goods, electronic means where the goods are located. Other than that, where it is performed. Individuals, wherever it was performed. But remember, if it is not put to use plus re-exported, then you'll use 13.2, not 13.3. Immobile property, you know very well. Event, you know very well. More than one place and more than one state, divide it. More than one place, let it be in taxable territory. For 3 services, intermediary, banking and hiring up for means of transport up to 1 month. Location of supplier. Transportation of goods, destination, passengers. Embarks on board services. First scheduled departure point, OIDR. Location of recipient, and finally for 2 other services government has said it would be location of recipient, not where it was performed. So this was about 13. What does section 12 deal with, sir? Section 12 deals with place of supply, domestic transaction services, where supplier and recipient are in India. Supplier and recipient are in India. If both supplier and recipient are in India, you determine it based on 12. See, if both are in India, should we give credit to the recipient, that is input tax credit? Yes sir, most of the cases we should. Government has also done the same thing. If recipient is the registered person, then most of the times in section 12, the place of supply will be location of the registered person. There are few cases where government has given a different place of supply, but generally in almost all cases, even if the service consumption per se looks somewhere else, government has said if recipient is registered, then let's give him the benefit of GST. Let's see this. 12.2. Generally, what will be the place of supply? Government has said if the recipient is a registered person, then location of the registered person. If he is an unregistered person, then in that case, location of recipient. But if that is not available, then location of supplier. If recipient's location is not available, then you will use location of supplier. But careful, if you are providing it to a registered person, can you use location of supplier? Because government wants to transfer the input tax to the state of the registered person. 12.3. Immovable property. The law says the place of supply will be where the property is located or intended to be located. And it also covers vessel or houseboat for stay. It says immovable property, houseboat or vessel for stay accommodation. Like houseboats, in a case of houseboat, the law clearly says where the houseboat is located or intended to be located. Now, in this case, there is one problem. Here, government has not divided it between RP and URP. Sometimes it will create a problem. Say suppose I am from Karnataka. I go and book a hotel in Mumbai. What will be the place of supply for that hotel? Sir, place of supply will be Mumbai. Where is the supplier? Supplier is in Mumbai, sir. Place of supply is in Mumbai, sir. What will he charge? C plus S. C plus S of Maharashtra. I am from Karnataka. I will not get ITC of this C plus S. Earlier people used to take. Now government has put it in the forms, that is GST returns itself, saying that no, this will not be eligible as input tax credit. So C plus S of other state is not eligible as input tax credit. But sir, this is leading to increase in cost. The answer is yes, though it leads to increase in cost, nothing can be done for this. This is how the law has been framed. Sir, but you said wants to give input tax credit to the state of the registered person. I said normally. In all cases government will try to give, but in some cases government has denied it. One case where they have denied it is immovable property. Let's see the next one. 12.4. Restaurant, outdoor catering, personal grooming, health and fitness. Government has said the place of supply for all this will be where the service is performed. Sir, again, will not transfer it to the state. Again, this is similar to immovable property where government does not intend to transfer the input tax credit to the state of the registered person. But see the next one. 12.5. Training. Now, training services, even if the training is done in Maharashtra, if I am of Karnataka and I am a registered person, then the place of supply will be location of registered person. See this. Training, if it is provided to a registered person, location of the registered person. If it is provided to unregistered person, then in that case, where it was performed. Because if it is provided to unregistered person, will URP get ITC? No. That's why government has said location of the performance. But if it is provided to registered person, location of the registered person. Here government intends to give the credit. 12.6. Admission to an event. Now, admission to an event, the place of supply will be where the event is held. That means entry fee, government has not done RP URP. Till now we have found 3 cases where government is not doing RP URP. These 3 cases, government does not want to transfer the credit to the state of the registered person's location. 12.7. Organization and sponsorship of an event. Government here has said RP, URP. For RP, location of RP. For URP, where the event is held. Now, careful about these two. 12.3 and 12.7, where government has said, if the property is outside India, or the event is held outside India, place of supply will be location of recipient. Be very careful. 12.3 and 12.7. Only 12.3 and 12.7. Be very careful. If the property is outside India, or the event organized is held outside India, then it will not be where the property is. It will not be where the event is. It will be location of recipient. Government has played smart. When both are in India, supplier as well as recipient are in India. Property is outside India. Why to miss on tax? Let's take the tax. And that's why government has said, even if the property is outside India, I'll use location of the recipient as place of supply. Then 12.8. Transportation. Transportation of goods including mail or courier. Government has said RP, URP. If it is provided to RP, location of RP. URP, where the goods were handed over for further transportation. Handed over for further transportation, not delivered. Don't mix up handed over with delivered. Careful. Handed over for further transportation, wherever it was picked up from. That's what government is trying to say. But if the goods are going outside India, then it will be destination. So if goods are going outside India, then it will be destination. Then 12.9. Transportation of passengers. Passengers also, does government want to give input tax credit to the state of the recipient registered person? Yes. RP, URP. RP, don't have to check anything. Location of RP. For URP, it will be where the person embarks for a continuous journey. 12.10. On-board services. Do you think government will give RP, URP in this case? No. On-board services, government has said, on-board services, it will be first scheduled departure point. Wherever the departure happened, that would be the place of supply. That means, can you see, totally 4 cases where government does not want to transfer the credit to the location of the registered person. 1. Immovable property. 2nd, restaurant outdoor catering. 3rd, admission entry fee. 4th, on-board services. Remember these 4, others will become easy. Okay, then you have 1211. See, 1211 basically deals with telecommunication service. Telecommunication service, very simple. If it is fixed line or DTH cable, direct to home cable, wherever that fixed line dish antenna is installed, that is the place of supply. Postpaid connection, billing address. Prepaid connection, wherever you do that recharge. Online recharge, location of the recipient. If that is not available, location of supplier. Even in any other case, location of recipient. If that is not available, location of supplier. Then we have 1212. Banking including stockbroking. Be careful. Banking and stockbroking. Banking and stockbroking, it's slightly different. Government has not divided it between RP and URP. What government has done in this case is, if the address is available on record, then such address. If no address is there, then in that case, location of supplier. Then you have insurance. For insurance, government has said RP, URP. RP, it will be location of RP, and URP, address on record, because no insurance is given without address, so it cannot be possible that you don't have the address. Then comes 1214, which is advertisement to central government, state government, local authority. Does central government, state government, local authority do a lot of advertisement? Yes. What will be the place of supply? Say suppose a TV advertisement given by central government. It is viewed throughout India. Should only Delhi get the tax because central government is in Delhi? Government has said it will be divided to each of these state. That means the supplier of this service has to raise different invoices state-wise. Is it, sir? But sir, based on what? For TV advertisement, government has said number of viewers or viewership. Who gives viewership, sir? Viewership is provided by a agency of government. They will give the viewership. Based on that, it will be divided to each state. Ratio proportion. Pamphlets, based on number of pamphlets distributed in each state. Hoarding advertisement, based on number of hoardings in each state. If the advertisement is done on railway, then length of track in each state. Then if it is done on a railway ticket backside, then in that case number of stations. Radio advertisement, number of radio stations in that each state. Say suppose it is done only for 4 states, then 4 states radio station is 1, 2, 3, 4. So the ratio will be 1, 2, 3, 4. Then say suppose SMS advertisement, then number of telecom subscribers. Internet advertisement, number of internet subscribers in each state. So basically you do a permutation combination or a ratio proportion and close the computation. Okay, then the law has also given certain divisions in IGST rules, saying that say suppose immovable property of 2 states is booked together for one particular price. Should the revenue be divided between those 2 states? Yes. But how will you divide it? Say suppose it is hotel accommodation or accommodation related, then based on number of nights. Any other case? Any other case it will be based on square feet or area. And say suppose sir it is houseboat, say suppose some time is spent near Karnataka waters, some time is spent near Kerala waters, then what will we do? Say suppose here 22 hours is spent near Kerala, 2 hours is spent near Karnataka, then the ratio will be 22:2 between Kerala and Karnataka. But sir, who will give these details? The law says as declared by the supplier who is providing houseboat services. If it is for an event, then say suppose for 4 events in 4 states, JK Shah Classes has appointed an event manager for 10 lakh rupees. Then in that case, it will be divided to each state based on generally accepted accounting principles. The ratio will be given to you, you have to just apply it, because there could be various modes based on which they do the accounting of that. However they are doing the accounting for that, based on that you will divide it to each state. If it is for telecom lines, say suppose for 4 states I get one bill, then number of points in each state. And if it is based on goods performance based services where repair is done or testing is done for more than one vehicle, then in that case government has said generally accepted or value of the goods. If it is same goods, then equally, otherwise different goods, then the value of the goods. If it is based on individual and for their performance based service on an individual, like makeup done at 2 places, Karnataka and Kerala, here government has said generally accepted accounting principles. This is provided in the IGST rules. So what have we discussed? We discussed 13, which is when supplier or recipient is outside India, and 12 when supplier and recipient are in India. Then we have section 11, which will start and end. Section 11, for import, the place of supply will be location of importer. Don't forget, it's not the port of import, it will be location of importer. Wherever the importer is located, say suppose importer is in Karnataka, goods have come in Chennai, what is the place of supply? Karnataka, location of the importer. Export, the place of supply will be outside India, and this is for goods. Don't forget, we learned 7 interstate supply, 8 intrastate supply, 9 territorial waters, 10 goods domestic transaction place of supply, 11 goods international transaction place of supply, 12 services domestic transactions place of supply, 13 services international transaction place of supply, 14 was OIDAR. Okay, last one is section 10, goods domestic transaction. Now this section 10 has 10(1)(a), 10(1)(b), 10(1)(c), 10(1)(d), and last one 10(1)(e). There are totally 5 points. 10(1)(a). Now 10(1)(a), government has said the place of supply where the supply involves movement. If the goods are moving from one place to another, what do you think? What should be the place of supply? Goods are moving from Karnataka to Kerala. What should be the place of supply? Government has said where the movement of goods terminates for delivery to the recipient. Terminates for delivery to recipient. So if the movement terminates in Kerala, then the place of supply will be Kerala. Okay, if the goods are ordered on the direction of the third person and some goods are being delivered to some other person, this is called as bill to ship to transaction. I'll give you an example. A is the supplier, B is the law calls him as third person because he has just ordered the goods and he is going to pay for it. We can call him as recipient also. And the goods are getting delivered to C, who is the job worker or the ultimate recipient. Then in that case, the place of supply, see, billing is happening here and shipping is happening here. This can be recipient or third person. This can also be recipient or job worker. See this again. Bill to ship to. Billing done to Mr. B, shipping done to Mr. C. What should be the place of supply? Government has said, in such cases, place of supply will be location of the third person on whose direction the goods were delivered. Sir, A to B, this will be the place of supply. What about B raising a invoice on C? If B is raising a invoice on C, then the place of supply will be C. But B will raise invoice to C only when C is the ultimate recipient. What if C is a job worker? C is a job worker. He will do the work. Say suppose you send him cloth, he will stitch the shirt and return it. Then in that case, this transaction will not happen. C will again send the goods back to B and charge service charges, and service charges you will determine based on 12. That is services domestic, not as per goods. Be careful, depends on whether two supplies are happening or one supply is happening. The place of supply for this transaction will be principal place of business of such third person, and this third person here in our example will be the one to whom the bill was raised. In fact, in ITC also you will see that B will get input tax credit for this. Then 10(1)(c) deals with a case where supply does not involve movement. Now if the supply does not involve movement, then the law has said place of supply will be where the goods are located. That is location of the goods at the time of delivery. If the goods are not moving, location of the goods at the time of delivery. So suppose I deliver the goods to you as is where is basis, that the goods are here in the warehouse, you take it wherever you want to. Then place of supply will be location of the goods, wherever the goods were located. 10(1)(d), if the goods are assembled or installed, then the place of supply will be where the goods were assembled or installed, location of assembly or installation. And last one, 10(1)(e), goods supplied on board of a conveyance. If some goods are supplied on board of a conveyance on the vehicle, you are selling those goods while the conveyance is moving, then in that case the place of supply will be where the goods were loaded / taken on board on such conveyance. Wherever you loaded those goods, that will be the place of supply. Clear? So we have discussed entire place of supply provision. Place of supply, don't forget that you have to determine supplier, recipient, type of supply. If you have these three things, you will get place of supply. Then you will compare place of supply with location of supplier to determine the type of tax. This is the step. From the question, try to derive these three: supplier, Where is the recipient? What is the type of supply? Goods, services, performance based, involves movement, does not involve movement. Then you determine place of supply based on the provisions. This will be determined based on 10, 11, 12, 13. Then you check place of supply and location of supplier to determine type of tax. At least this you write and keep, will help you immensely before the exam. Now go through place of supply, spend some 10-15 minutes to see some questions of place of supply.
In this video, we are going to talk about valuation. Section 15 of CGST Act 2017 deals with value. Value would mean the transaction value. And what's the meaning of transaction value? Transaction value is price actually paid or payable, and it is subject to certain adjustments. But when will this transaction value be accepted? It will be accepted when two conditions are satisfied. What are those two conditions? One, supplier and recipient are not related persons. This is the first condition. And the second condition is price is the sole consideration. That means the price which is being charged, that's what is being received. There is nothing in addition to that which is being received. If both these conditions are satisfied, then transaction value will be considered as value. Now what is included in value? What is excluded in value? Because this is part of transaction value. So transaction value has some inclusions. It also has some exclusions. Let's see what is included in value, what is excluded from value. Pehla cheez. Any tax other than GST would be included. But be very careful. GST and compensation cess will never be part of value. GST and compensation cess are part of value only while calculating 50,000 limit for e-way bill. Otherwise, GST and compensation cess will never be considered as value, neither in aggregate turnover nor in value for the purpose of section 15. Only at one place for checking that 50,000 for e-way bill. Now, remember one more very important circular which is issued by CBIC saying that TCS, tax collected at source under Income Tax Act 1961 will not form part of value. We have clarified that TCS will not be considered as part of value. Then, what about any incidental charges? Any incidental charges which are related to the supply, any such charges will be included in value. What about subsidy? Yes, subsidy. If it is directly linked, then in that case it will be considered as part of value. But if it is government subsidy, in that case you don't consider it as part of value. Thereafter, what about any interest? Yes, interest on delayed payment of consideration for a taxable supply will form part of value for the purpose of determining GST liability. And then we have a very important point, that is third party payment. Hey, what is this third party payment? When we say third party payment, that means supplier has to pay someone. Recipient pays it to that third party on behalf of the supplier. Again, supplier has to pay someone. Recipient on behalf of the supplier makes a payment to that third person. Such payment will be added to the value. Discount. Any pre-supply discount will not form part of value if it is shown on the invoice. The moment it is shown on the invoice, pre-supply discount will not form part of value. What is pre-supply discount? Discount given at the time or before the supply. Before supply or at the time of supply. If it is later on, then it is not considered as pre-supply discount. In that case, it is called as post-supply discount. But remember one thing, post supply discount will be excluded only and only if it is known at the time of supply plus ITC is reversed by recipient. These two conditions needs to be satisfied, only then post supply discount will be excluded. And how do you do this? By giving a credit note. So supplier will give a credit note and it should be within the time limit. The time limit is due date for filing September month return after the financial year or date of filing annual return, whichever is earlier. If it is within that particular credit note time limit, in such cases, the supplier will issue a credit note. The moment I issue a credit note, I will reduce my liability and the recipient has to reduce his ITC. If he reduces his ITC, then I can also reduce my output. That means that particular post supply discount will be as good as not considered liable to GST. Clear with this? Yes. समझ में आया ये? हाँ sir. तो ये inclusions and exclusions from transaction value. Now, whenever you get a question in case of valuation, see, there are two important things which you should remember. One is a case where inclusions will be given to you, exclusions will be given to you, and those are not part of the main value. In that case, you will add the inclusions and subtract discount or government subsidy, which is already not subtracted, and arrive at transaction value. The second case might be where an all-inclusive price is given to you. When an all-inclusive price is given to you, in such cases, you will have to reduce the exclusions, you will have to reduce GST to arrive at transaction value. Which one will you reduce first? Do you reduce the exclusions first or GST? You first reduce all the exclusions, and once you have reduced all the exclusions, thereafter you reduce or remove GST by treating it as inclusive of GST. You remove GST and arrive at your transaction value. So these are the types of questions which can be asked. Be very careful about one important point: subsidy. See, we are very clear with one thing. Subsidy, if it is directly linked to the price, it will get added to the value. But if it is already added, don't add it again. Clear? Yes, sir. Let's talk about subsidy which is not linked to the price or government subsidy. In such cases, it is not liable to GST. Yes, sir, it is not liable to GST. What will you do to the subsidy? If it is already subtracted, please don't subtract it again. If it is already subtracted, please don't subtract it again. If you are not passing the benefit to your recipient, that means you are getting 10 rupees plus you are getting 2 rupees as government subsidy. GST will apply on this 10 rupees. But say suppose you say your customer, instead of 10 pay me 8. Instead of 10 pay me 8. In that case, GST will apply only on 8 because this government subsidy will not be liable to GST. So obviously it would be given in the question, or you can make an assumption whether you are passing the benefit of government subsidy or you are not passing the benefit of government subsidy. So this is transaction value, inclusions and exclusions. Now what happens in a case where transaction value is not accepted? In such cases, you move to the valuation rules, and we are now going to discuss rule 27 to rule 35. Sit back, relax and watch. Now, when we talk about rule 27, what does it say? Rule 27 says when consideration is not wholly in money, you can use me. When consideration is not wholly in money, you can use rule 27. Now, what does rule 27 signify? It first says use the open market value. And what is open market value? The price at which you sell such goods at the same time or at or about the same time to unrelated persons. Say suppose I give this pen as a gift. I am a seller of this pen. I give this pen as a gift to a related person, or I give it as a gift to a friend. The moment I do any such transaction of gift either to a related person or friend, in such cases transaction value will not be accepted. Now rule 27 deals with a case where consideration is not wholly in money, or you have some other consideration. Being a friend, you have just given this as a gift. Now when you give this as a gift, in such cases, say suppose normally you sell this pen for 10,000. In such cases, what would be the open market value? It would be 10,000. The same thing is used for related person in rule 28. Rule 28 also starts with open market value. This deals with related person transaction, and 27 can be used for that friend example. But in both the cases, the first thing which you use is open market value, the price at which this product is being sold to unrelated persons, and where price is the sole consideration. So this is open market value. Now, the second segment in this rule 27 is you can use the consideration which you have received in money plus that non-monetary consideration. You will convert it into money and arrive at the transaction value. This is the second step. Sir, can I use second one before first one? The answer is no. The answer is a plain no. That is not permitted in the law. The law says follow this order. First one, second one. If both are these are not available, then like, kind and quality. Like, kind and quality. Similar products being sold, in such cases you can use the price of sale of similar products. Now, do you think this money and non-monetary can be used for related person? अरे वो लोग तो एक रुपया भी नहीं देंगे. This cannot be used. So the second thing which is there in rule 28 is like, kind and quality. So you can use like, kind and quality. Sir, if this is also not available, in that case, there are two options, rule 30 and rule 31. Rule 30 says cost plus 10% and rule 31 says reasonable means. Reasonable means. Same rule 30 and 31 are also applicable for rule 28. So the order is very clear. 1, 2, 3, 4, 5. Similarly, same method you will use rule 28. Now, remember one very important aspect. When you talk about this 4 and 5, government has given an option. For service industry, you can use 5 before 4. Can use 5 before 4. Because obviously, cost plus 10% might not make sense in case of service industry. So they can go by any other reasonable means, valuation report, similar transactions at different point of times. Those can be used as value in rule 31. Okay. Now, two important things which you should remember in rule 28. 1. If the recipient can take ITC, then whatever you have mentioned on the invoice, that invoice value will be considered as open market value. Wonderful. If recipient can take full ITC, then whatever you have considered as invoice value, that will be considered as open market value. This is an advantage given for rule 28 valuation. The moment you are able to prove that your recipient can take full ITC, then whatever you have charged, that would be considered as value. Because you are dealing with related person, this is possible. For unrelated person, how would you find out whether that recipient can take full ITC or not? In examination, obviously it will be given in the question. This was the first one. The second important consideration is you have one more alternative. Instead of using this open market value, you can derive the value at 90% of price at which recipient is making further supply. So whatever recipient is making further supply at, you can use 90% of that, and that can be regarded as value. So this is other method which is available in case you don't want to go by open market value. So if I to sum up, if your related person can take full ITC, then please take the invoice value, game over. If that is not available, then you have open market value, or you can also select 90% of the price at which recipient makes further supply. Obviously, this is possible in case of related person transaction. Rule 29 deals with agent. Now, when we talk about agent, what would be the value in case you supply through an agent? What agent are we talking about? Don't forget that this agent which we are talking about is the agent which is covered by Schedule 1. What was Schedule 1? Permanent transfer of business asset was there. Related person, distinct person. Third one was principal and agent, where the billing is done in the name of the agent. We are talking about that agent which is covered by Schedule 1. So in such cases where the agent is covered by Schedule 1, government has said that you can use open market value or you can use 90% of the price. If this is not possible, 90% of the price, same 90% of the price at which recipient, that is agent, makes a further supply, that can be used. Otherwise, government says you can apply rule 30 or you can apply rule 31. So rule 30 can be applied or rule 31 can be applied. Clear with this? Yes. So this is how rule 27 to 31 get covered. 27, open market value, money plus non-money, like, kind and quality, cost plus 10%, reasonable means. Rule 28, only 4 methods, but there are 2 important points you should remember. Rule 29, agent, open market value or 90% of the price at which recipient makes further supply, that's not possible. Then you have the rule 30 and 31 provision which is common across. Now, once we complete this, what's the next thing? We have rule 31A. How do you value bets? Betting. Government has said bets 100% of the bet value. Whatever is the bet value, that will be considered for bets. And if the bet value is 200, then GST will apply on that entire 200 rupees. So this is about bets. Now what happens in a case where you are talking about a lottery? Now in case of lottery, government has said that it would be 100 divided by 128 into face value, or you can use 100 divided by 128 into price notified of that particular lottery, whichever is higher. So any of these two can be used for value. Sir, why is this 128? 128 because government is treating that value as inclusive of GST. The government is giving this benefit, saying that 100 divided by 128 into face value. Now, this is an amendment. Earlier, it was 100 divided by 112 and 100 divided by 128, depending on whether it is state run lottery or state authorized lottery. So for state run lottery, the GST rate was much lower. Now both are at par. At present, both are considered at 28% GST. Clear with this? So at present, whether it is state authorized or it is state run, it does not make any difference. Now, when we talk about rule 32, again, an important rule, some questions come out of this. Rule 32, be very careful. Rule 32 provides you some schemes. What schemes, sir? Say suppose you are an air travel agent. Then you have an option. Either you can discharge GST based on your commission, that is method 1, or you can adopt the valuation given in rule 32. This is again optional to you. For domestic bookings, it is 5% of the basic fare. And what is basic fare? The definition of basic fare is the fare on which commission is normally payable to the agent. In case of international booking, it is 10% of the basic fare. What is basic fare? Fare at which commission is normally payable. This is for the air travel agents. Remember, institute could give you a question of rail travel agents. Hey, rail travel agents don't have this benefit. This is only for air travel agent. For rail travel agent, he has to pay GST on commission which he charges from his customers. Then we have foreign exchange. A person who is dealing with money exchange or money changing services. In such cases, either he can pay GST based on his commission which he charges, or he can go by particular valuation method. He has two options. One, valuation method given, and second is slab rates. These are the two options. Now, first option depends on whether the currency has INR as one of the component or both are non-INR currencies. See, for most highly traded currencies, government notifies something known as RBI reference rate. So when we talk about RBI issuing these RBI reference rate, if RBI reference rate is available, then reference rate minus transaction rate into number of units. Reference rate minus transaction rate into number of units. If reference rate is not available, then the law says 1% of transaction amount. If none of the currencies is INR, in that case, convert both the currencies in INR and then lower of the two, multiply it with 1%. Then you can multiply it with 1% and that would be considered as value. So three things. If RBI reference rate is available, then you can use that reference rate. If RBI reference rate is not available, then you can use 1% of the transaction amount. If both the currencies are foreign currencies, convert both into INR, lower of the two, multiply it with 1%. What happens in option 2? In option 2, government has given slab rates. So if the amount exchange is up to rupees 1 lakh, in that case, the value will be 1% of transaction amount, minimum 250. When you talk about more than 1 lakh and up to 10 lakh, in such cases, it would be 1000 plus 0.5% of the amount in excess of 1 lakh. In excess of 1 lakh. Because for first 1000, you have already considered 1000 for the first 1 lakh rupees. And finally, when it is more than 10 lakh, in such cases, 5500 plus 0.1% of the amount in excess of 10 lakh, maximum being 60,000. How did we get this 5500? First 1 lakh, it is 1000. For next 9 lakh into 0.5%, it would come to 4500. 4500 plus 1000 coming to 5500. Clear with this? Now if you see very carefully, this will always give you lower answers. Because here it's 0.5 and 0.1. While here government is using 1% throughout, irrespective of any amount. So normally option 2 is preferred by all banks dealing with foreign exchange or authorized dealer who deal with foreign exchange. Clear with this? Yes. So this was about money changing services. Third one is life insurance sector. Now life insurance sector, what is the benefit given? Life insurance sector have an option. See, first of all, there can be two types of policies, risk-based policies and investment-based policies. When we say risk-based policies, entire amount is towards risk. The moment we say entire amount is towards risk, whatever premium is charged, entire premium will be liable to GST. Investment-based policies has some amount which is invested and some is towards risk. To the extent it is towards risk, GST will apply. To the extent it is towards investment, investment is mutual funds, is just like securities, and the moment investment, we speak about investment, tax should not be levied. Now the question is whether the breakup is available or not. about this investment portion and risk portion. So for investment based policies, there could be two cases. One, breakup is available. What breakup? Breakup of a risk and investment portion is available. If breakup is available, in that case it becomes very simple. Risk portion, GST will be applicable. Investment portion, no GST. Correct? Investment portion, GST would not be applicable. But if breakup is not available, no breakup informed to the policy holder. While issuing the policy, you have not issued any breakup. In such cases, the law says for first year premium, value will be 25% of the amount of total premium. That means the law is assuming that 25% is towards risk and balance 75% is towards investment. What about subsequent year premium? For subsequent year premium, the value will be 12.5% because obviously for subsequent years, the element of service is less compared to the first year. Correct? Okay. What about single premium annuity policy? When we talk about single premium annuity policy, here what happens is you pay the premium once and thereafter you keep getting returns. This is normally taken by citizens who are old in age. So single premium annuity policy, you invest one big corpus, one big fund, और उसके बाद you keep getting returns. So for single premium annuity policy, the law has said that value will be 10% of the premium charge. That means it is much lower. If this was not written, then the tax would have been on 25%. Because in single premium annuity policy, obviously you have only one premium which you pay. Yes? Okay. Thereafter, the law also provides for second-hand goods. What would be the value for second-hand goods? Now, in case of second-hand goods, the law has provided for two things. First one, second-hand goods, in case it's a second-hand dealer, in such cases, it would be sale price minus purchase price. And obviously, he should not take ITC on purchases of that particular product. Sale price minus purchase price on the margin. This is also called as margin scheme. On the margin, he can discharge GST. Say suppose he does some minor processing. Yeah, that minor processing is allowed and he can also take ITC on such minor processing. There is no restriction. But dealer also has one option. Say suppose he wants to take ITC. In such cases, he will discharge GST on entire sale price. So these are the two options available to a person who is a dealer of second-hand goods. Now, what about banks where they repossess the goods? What happens in case of banks? I purchased a car. I could not pay EMI. What will bank do? Bank will take the car from me. In such cases, what would bank do thereafter? Bank would sell the car. Whether GST is applicable on entire sale price by the bank or lower. In such cases, the law has said when bank repossesses, it would be sale price minus purchase price of original buyer. Be very careful. Purchase price of original buyer minus 5% per quarter or part of the quarter. Don't forget this. This is used at lot of places. 5% per quarter or part of the quarter as depreciation. So, based on this, you will derive the purchase price of original buyer minus 5% per quarter or part of the quarter, and subtract it with sale price. Depending on what value comes, you have to pay GST on that particular value. Again, no concept of ITC in case bank repossesses, and say suppose it comes negative. If any of these comes negative, then it will be regarded as 0. So say suppose there are 4 positive transactions and 1 negative. You cannot set it off. 4 positive transactions, you have to pay GST on 4 positive transactions. 1 negative transaction will be regarded as 0. So be very careful about second hand goods. Dealer sale price minus purchase price, bank repossessing sale price minus purchase price of the original buyer minus 5% per quarter or part of the quarter. Part of the quarter is considered to be full quarter. 4 quarters, Jan to March, April to June, July to September, October to December. Doesn't matter whether you calculate through financial year or calendar year, same quarter calculations would come. Clear? Yes. And the last discussion in this is vouchers. Now vouchers, the value for the purpose of vouchers would be the face value of the voucher, which is redeemed. Whenever we talk about a voucher, it is possible that you have purchased 1000 rupees voucher for 10 rupees. If you have purchased 1000 rupees voucher for 10 rupees, the value would be 1000. That means to the extent you are redeeming that voucher for a particular goods. Clear? Government wants more tax, and that's why for vouchers they have fixed face value or redeemable value of the voucher as value. Clear? Okay. So this was rule 32. We have discussed rule 32, air travel agent, money changing services, life insurance, second hand goods, and finally vouchers. Now, we are left out with 3 very simple rules. One is rule 33, which talks about pure agent. Now, when we talk about rule 33, that is pure agent, the main and the most important thing which you should understand. Now, say suppose I have incurred an expenditure as a pure agent. When do I call someone as a pure agent? I call a transaction or an expenditure as incurred as a pure agent when I, as the supplier, I have not used it. I recover actual value. I don't charge it along with my complete fees as a bundle. In such cases, I regard it as pure agent. And I should not be obligated to pay it. The recipient is obligated to pay it. Let's take some example. Say suppose I go for an audit to Maharashtra. When I go for an audit to Maharashtra, I incur air travel expenses और I also incur hotel expenditure. और उसका मैं claim कर लेता हूँ. Air travel, hotel expenditure. Who has used that air travel? Who has used that hotel? Who is liable to pay the hotel? In such cases, I have not incurred such expenditure as a pure agent. When I raise an invoice, I have to add it to the value. But say suppose I am a custom house broker. I incur some custom duty which importer had to pay. Some dock charges which importer had to pay. Some other port charges which importer had to pay. And while raising my invoice, I add it and show it separately on the invoice. Was I liable to pay those? No. Am I providing such service to him like payment of custom duty? No. Have I separately indicated? Yes. Have I used those services? The answer is no. In such cases where the importer was liable, I have incurred those expenditures as a pure agent. And if I incur those expenditures as a pure agent and then claim a reimbursement, GST would not be applicable. So that is about rule 33. Then we have rule 34. Now what does rule 34 deal with? Rule 34 deals with exchange of foreign currency. Whenever there is a foreign currency transaction, how do you convert that into INR? The law very clearly provides it for goods as well as services. Now, first question is which date do you consider for the purpose of converting foreign currency into INR? That's first thing. Which date do you consider? Second aspect is whose notified rate. Because see, there could be a transaction rate, there could be a rate which is notified by RBI, there could be a rate which is notified by CBIC. So which rate do you use? So which date and whose notified rate? Which date for goods? Time of supply of goods. Whenever the time of supply occurs, that date. For services, again time of supply of services. And whose notified rate do you consider? For goods, you consider CBIC notified rate, and for services, you consider generally accepted accounting principle. Based on your AS, Ind AS, you have to determine the rate of exchange. And as on which date? As on the date which comes on the time of supply. So this is about rule 34. And rule 35 finally talks about value being inclusive. Value being inclusive. Say suppose I have charged 118 including tax, and the GST rate was 28%. I have charged 118 including tax. Then the law says this 118 will be considered as including GST. 118 which I have collected will be considered as including GST. So I'll divide it by 128 and multiply with 28 to find out what is the GST which is payable by me. So if I have failed to collect tax from the customer, or if they have not paid me any extra tax, in such cases, whatever I have received will be considered as inclusive of GST. And one very important circular to end this video. Remember one thing. If the supplier is liable to pay something, supplier is liable to pay something, or supplier is liable to provide something, and recipient gives it free of cost, then this will be added to the value. But if it was obligation of the recipient and recipient gives it free of cost, then it will not be added to the value. Again, say suppose the recipient gives something free of cost to the supplier. In such cases, two things. Was it the obligation of supplier? See this. If it was obligation of supplier and recipient is giving it free of cost, in such cases, add to value. But if it was already an obligation of recipient and recipient gives it free of cost, recipient को ही देना था and recipient is giving free of cost, do nothing. Be very careful about this one particular aspect which comes from a circular regarding OEMs, original equipment manufacturers and component manufacturers. So this is dependent on that particular circular. Be very careful about this particular fact. Yes.
Now let's talk about reverse charge mechanism under section 9.3 and 9.4, and we'll also discuss about e-commerce operator liable to pay GST for notified services supplied through it. Now first let's see various entries which are there in 9 subsection 3 and 5 subsection 3. 9 deals with CGST Act while 5 deals with IGST Act. The first service which is there is director providing service to a body corporate. Now if director is providing service to a body corporate, then the body corporate will be liable to pay GST under reverse charge mechanism. But be very careful. If the director is an employee, then in that case there is no question of reverse charge mechanism because it is neither supply of goods nor supply of service. It is covered by negative list. So be very careful before applying a charge. Check whether it is a taxable supply, whether GST is leviable or chargeable or payable. You need to be very careful. For an exempt transaction or for a negative list transaction, we can never apply reverse charge mechanism because there is no charge at all. Then the next one is residential property, that is a residential dwelling given to a registered person. If a residential dwelling is given to a registered person, then the registered person will be liable to pay tax under reverse charge mechanism. Doesn't matter whether that residential dwelling is given for residential use or commercial use. The question is whether it is a residential dwelling and whether it is given to a registered person. Plus, it doesn't matter whether the supplier is registered or unregistered, recipient will have to pay the tax under RCM in this particular case. Then, author providing services to a publisher in respect of temporary transfer in an IPR. So basically he is earning royalty from writing a book and giving it to the publisher for further sales, and he'll get a royalty amount. In such cases, author is not required to register. In that case, publisher will pay the tax under reverse charge mechanism. Now, here there is an option which is available to the author that he can take registration and pay tax under forward charge. There are totally 3 sectors which get this option of paying tax under forward charge. One is author, second one is goods transport agency, third one is renting of motor vehicle designed to carry passengers. We'll talk about all the 3, but remember these 3 very clearly. Then music composer or photographer to a music company, director and like, music company and producer and the like. So in this case, the music company or producer will be liable to pay tax under reverse charge mechanism. Obviously, who is a stronger person? Music composer or music company? Music company. So in most of the cases, there were 2 objectives because of which reverse charge mechanism was brought. One, to shift the liability from weaker person to a stronger person, and the second purpose was whenever government was unable to collect tax from supplier. These are the 2 basic reasons why reverse charge mechanism is there in the law. Like US person providing service to Indian person. Government was unable to collect tax from the US person and hence they shifted the liability to the recipient. Or weaker person, it's difficult to catch a director or a music composer or an author, shifted the liability under reverse charge mechanism. Then insurance agent providing services to an insurance company, and the insurance company will be liable to pay tax under reverse charge mechanism. Security services. Careful. It says security service provided by any person other than body corporate. Careful. The moment under RCM we have other than, that means who will be responsible to pay the tax? If body corporate is providing this service, then it will not be a case of reverse charge mechanism. In fact, it will be a case of forward charge provided to a registered person. And here government has said other than a composition taxpayer, because for a composition taxpayer government has given a relief in this particular case. Plus you will find one more relief. If security service and GTA, these 2 services are provided to government department, government authority, where they have taken registration only for the purpose of TDS, tax deducted at source, then in that case again reverse charge will not be applicable, because if government department has only taken registration for TDS, then in that case it does not make sense for them to pay tax under reverse charge mechanism, so they have excluded themselves. This is there in 2 services, security service, GTA, and this other than body corporate, which you see, this is there in two places: security service, renting of motor vehicle. These are the finer points which you need to be very careful before the examination. Then government providing any service to a business entity. Careful. This excludes first three limbs. What was the first three limbs? Remember, Department of Post related services, transportation of goods or passengers, aircraft or vessel related services. These are covered under forward charge. Here RCM will not be applicable. Plus, renting of immobile property was also excluded from this entry. But then government wanted to bring renting of immobile property under reverse charge mechanism. So what did they do? They said renting of immobile property provided by government to a registered person, then registered person will be liable to pay tax under reverse charge mechanism. Careful. In this entry and this entry, there is a difference in language, which is a wider term. Obviously, business entity is a wider term because business entity could be a registered person or unregistered person. Though government has given an exemption in government to business entity, that if the business entity's last year turnover in the preceding financial year does not exceed registration limit, then it will enjoy a exemption. But that is based on preceding financial year turnover. Doesn't matter whether he was registered or unregistered. So remember two things. One, business entity is very wide term because it can cover a registered person or unregistered person. Registered person is narrow compared to business entity, and body corporate would only cover LLP and company. Okay. Then we have overseeing committee of RBI. Now this overseeing committee of RBI providing services to RBI. Basically this committee looks after and tries to find out the bad loans in the books of the banks. So these overseeing committee members get paid from RBI. In this case, government has said that RBI will be responsible to pay the tax. Then renting of motor vehicle designed to carry passengers. And then here the law says other than body corporate. Careful, there are only two cases where other than body corporate is mentioned. One is security service and second one is renting of motor vehicle. And here the law has said to a body corporate. Careful. In security services, they have mentioned registered person, which is wider term compared to body corporate. Body corporate is a much narrow term. That means this combination has to be met. Other than body corporate, providing service to a body corporate, only then RCM can apply. Any other combination, it would be a case of forward charge. Plus, it also says not paying tax at 12%. The supplier is not paying tax at 12%. That means if the supplier is paying tax at 12%, it will not be a case of reverse charge mechanism. It also makes sense. Government has given an option to renting, saying that they can pay tax under forward charge. I told you there are three services where option is given. One is author. Second one is renting of motor vehicle. He can pay tax under forward charge. And the rate of GST given is 12%. Plus, in this, fuel charges should be included in the invoice. Like the invoice value should not just be for renting, it should be also for fuel charges. Then the next entry. is GTA service. GTA provided to registered person or specified person. Again, let me tell you, this is the third case where an option is given to GTA that GTA can take registration and it should not change in that financial year. For the entire financial year, they will have to pay tax under forward charge. Obviously, financial year wise they can shift, but otherwise in a financial year, if they choose to pay under forward charge, then they will continue to pay under forward charge. If GTA is registered and paying under forward charge, obviously there will be no RCM. Who is this specified person? All these are registered in some or the other law. Factory, registered under Factories Act. Society, under Society Act. Cooperative Society, under Cooperative Society Act. Partnership firm, Indian Partnership Act. Body corporate, Companies Act. Casual taxable person, we will again discuss in registration. Then recovery agent, providing service to banks or financial institutions. Then the banks or financial institutions will be liable to pay tax under RCM. Thereafter, the next entry deals with arbitral tribunal, providing service to a business entity. Don't forget, if business entity's last year turnover is below registration limit, then it enjoys an exemption. Doesn't matter whether that business entity is registered or unregistered. The exemption is dependent on last year turnover. Then advocate or senior advocate, providing legal service. Don't forget, only legal service is covered by RCM to a business entity. Again, the business entity will be liable to pay under RCM. Again, this has an exemption. If last year turnover is below registration limit, it will enjoy an exemption. Thereafter, sponsorship service. Sponsorship service, the service provider might be anyone, provided to a partnership firm or a body corporate, not an individual. Be very careful. Recipient has to be a partnership firm or body corporate for RCM to trigger in this case. Then, person located outside India to a person in India. Outside India, you call it as non-taxable territory, and India, call it as taxable territory. So the person in India will be liable to pay tax under reverse charge mechanism. Then you have transportation of goods in a vessel from outside India to India. Then in that case, importer will be liable to pay the tax. Obviously, there is a Supreme Court judgment on Mohit Minerals saying that importer will not be liable because on this GST is already discharged, being a composite supply. So your attempt will be the last one, November 23, where this entry is there. After that, it is being deleted because Supreme Court has already said that this is not a valid entry. You can't catch the importer who was not a party of contract, but Supreme Court has not said depending on not a party. They have said as on the entire value custom duty is discharged, there will be no additional GST under reverse charge mechanism, applying the principle of composite supply. I'll give you an example. Say suppose you import goods for $4,000, import from US goods, and you incur $200 as transportation charges. So you'll end up paying custom duty on $4,200 totally. So government has said that this $200 will not be liable to GST, and that's why RCM failed in this case. Don't apply it anywhere else, just be aware of this particular fact in this particular case. Okay, then you have individual direct selling agent. Careful, institute has tested this again and again. Individual direct selling agent providing services to banks. If it is other than individual, then in that case it would be a case of forward charge, because RCM will apply only when this person is a individual direct selling agent. Lender of securities to borrower of securities. Taking shares on rent. Again, the borrower will be liable to pay under reverse charge mechanism. Then you have an entry with regard to business facilitator providing services to banks. But don't forget, if it is for a rural area, then it enjoys an exemption. The taxability will arise only if it is an urban area. Careful, agent of business facilitator is not covered by RCM, only business facilitator to bank. The last entry is agent of business correspondent to a business correspondent. This business correspondent was a kirana store, while business facilitator is a marketing agent. So business facilitator, bank will pay the tax, but business correspondent to bank is forward charge. Don't mix up business facilitator and business correspondent. Business facilitator, marketing agent. Business correspondent, those kirana stores which are helping the bank to carry out banking transactions on behalf of the account holders. So here business correspondent is liable if he is paying commission to agent. But when business correspondent is providing services to bank, this is not covered under reverse charge mechanism. Be careful about this distinction in the examination. So these are the entries which are covered under reverse charge mechanism. There is one more entry which deals with landowner giving development rights. That I will discuss in a while. Let's first try to recall this. You can just remember it by a small story. Say suppose there was a person, Mr. A. He was a director in a music company, and also he used to write some books. The company took a residential property on rent for the director, so company was paying for it. One day he received a call from terrorist. Company arranged for insurance agent, also provided security services, because if he dies what will happen, so they provided all these facilities. They also took help from government and RBI. He used to travel in a rented cab, sometimes hide in a truck and go home. Goods transport agency. One day he was killed by a recovery agent. Company filed a case in the arbitral tribunal with the help of an advocate. They sponsored an event outside India in the memory of Mr. A. 17th, I don't think it will be asked in the exam, because Mohit Mineral Supreme Court judgment is there saying that tax will not apply in this case. So they will not ask you 17th entry. Then there are 4 entries which you need to recall. Individual direct selling agent, lender of securities to borrower, business facilitator to bank, agent of correspondent to business correspondent. Now, one important amendment which has happened for November 23 is wherever government is mentioned here, it will include tribunal and court. Why has government done this, saying that wherever government is mentioned it will include tribunal and court? See, tribunal and court providing a service is covered by negative list. But say suppose they are giving up property on rent within the court or tribunal, a HDFC bank ATM is there, then what will happen? The treatment will be same as government. Government to business entity. Business entity will pay the tax. Same way, tribunal or court. Other than fees, see, fees taken by court or tribunal is covered by negative list. That fees is court fee. Court fee is anyways covered by negative list. What about renting which they are doing or any other service which they are providing to business entity? Then business entity will be liable to pay tax under RCM. So what has government said? Wherever government is mentioned, it will include tribunal and court as well. That's something which is very important for your exams. Now coming to 9.4/54. 9.4, the law says if there is a supplier who is unregistered and there is a recipient who is a registered person, then for notified services or goods, the registered person will pay the tax under reverse charge mechanism. In this, only one sector is notified, that is real estate sector. This is the only sector which is notified under 9.4/54. Now, what does it deal with? See, any promoter or developer of a project, at least 80% of inputs and input services to be purchased from registered persons. If there is any shortfall, then in that case, registered person will have to pay tax under RCM. Say suppose your 85% purchases is from registered person. Any problem? No. If 75% is from registered person, then for the balance 5%, the registered person will have to pay tax under RCM. That means, do you agree you have a 20% margin, that 20% of your total purchases you can purchase from unregistered person? Now, cement has a very high rate, 28% GST, while sand has 5% GST. In this 20% leeway or margin which you have, you will prefer buying high GST product from unregistered person. And that's why government has said cement only to be purchased from registered person, otherwise builder or promoter or developer to pay tax under RC. And capital goods only to be purchased from registered person, otherwise the builder, promoter, developer has to pay tax under reverse charge mechanism. This is what is covered under 9.4. Now linked to real estate, there is one entry in 9.3 as well, which is related to joint development agreements. See what happens in joint development agreements. There is a landowner. Landowner is giving development rights to the builder, and builder will provide construction service and they will share the flats. Say suppose there is a plain land, 100 flats will come up, 50 flats landowner will keep, 50 flats builder will keep. Builder will do the construction, landowner is contributing development rights of the land. Classic case of barter. Now the question is whether development right should be taxable. Here there is one exemption entry and one RCM entry. See, say suppose builder is getting 50 flats. Out of this 50 flats, under construction he sold 24 flats. You very well remember, under construction property GST is applicable. So when builder is selling a under construction property, will government get GST? Yes. And that's why government has said development rights to the extent of under construction property sold by builder, this will be exempt. Why? Is government giving a benefit? Government is avoiding double taxation because here they have already collected GST. They have given an exemption here. Now 26 flats which will be constructed and sold. There will be no GST charge from the home buyer. Builder will not deposit anything because he is not required to collect anything. This is covered by negative list. So government has said, to the extent of unsold inventory, that is those which are being sold after completion, then in that case here it is taxable under RCM 9(3). Who has to pay the tax? Builder will be required to pay the tax. This is a case of 9(3), not a case of 9(4). Be very careful. Logic is very simple. If builder is discharging tax here by collecting it from the home buyer, then this is exempt. If builder is not charging GST because he is going to sell constructed property, then it will be taxable. What will be taxable? The landowner giving development rights. Builder will have to pay the tax under RCM. Okay. The last discussion in this is 9(5). 9(5), where e-commerce operator is liable to pay tax for notified services. There are totally 4 services which are notified. One is transportation of passengers, very wide. In a radio taxi, motor cab, maxi cab, omnibus, motorcycle or any other motor vehicle. Even if it is auto rickshaw, who will be liable to pay tax? E-commerce operator. And it's a plain entry. Doesn't matter whether supplier is registered or unregistered. Who will pay the tax? Eco will pay the tax. So will the supplier take registration? No need. No need. Because Eco will be liable to pay the tax. Second entry is restaurant service. Restaurant service as well. Doesn't matter whether supplier is registered or unregistered. Who will pay the tax? E-commerce operator will be liable to pay the tax. But there is one exception here. If the restaurant is in a specified premise. What is a specified premise? Remember a restaurant in Taj. So there is a Taj hotel and there is a restaurant there. For that restaurant, Eco will not pay the tax. The supplier will be liable to pay the tax in such cases. Reason being, the reason is very simple. Government is clear on this, saying that specified premise, that is restaurant within the Taj hotel, let the Taj hotel pay the tax, not the e-commerce operator, that is Swiggy Zomato will not pay. Taj hotel will pay the tax. Sir, is it defined what is a specified premise? Yes. A premise where the price of any unit of accommodation is more than 7,500 per day. And careful, this more than 7,500 per day is declared tariff, not value. Sir, what's the difference? Declared tariff is before discount, while value is always after discount. You give a deduction for discount and then you charge on the balance amount. But this declared tariff is before discount. So if even in a single unit of accommodation, any room where the charges shown to the customer on the face of it exceed 7,500 per day, then it will not be a case of 9(5). It will be a case of forward charge, because law believes these hotels will be registered. They are capable of discharging GST. Let me not put it under 9(5). Eco is not responsible. Then third one is accommodation services. Accommodation services, be very careful. If the supplier is liable to register, that means his turnover is more than registration limit, then no 95. That means 95 will apply only when it's a case where that hotel accommodation provider is not liable to register and is unregistered basically. Then in that case, eco will be liable to pay. Last one is housekeeping services. Housekeeping services, again the government has said the same thing. If the supplier is liable to register, then there will be no 95. So these are the 4 covered: transportation of passengers, restaurant except in a specified premise, accommodation, and housekeeping, where you need to check whether the supplier is liable. First 2 plain entries except for the specified premise point. So this was reverse charge mechanism and e-commerce operator. Now let's talk about exemption. I'll tell you the key points and the mistake areas in all the entries in exemption. See, whenever you are writing a examination answer, you can mention section 11 read with notification number 12/2017. This is for CGST Act. And for IGST Act, section 6 notification number 9/2017. This is for IGST Act. So in any answer for exemption, you can easily use either 11 read with notification number 12 and section 6 read with notification number 9/2017. One deals with CGST Act. Normally if the question is silent with regard to C+S or IGST, then you will use CGST Act section. Now basically these sections give the power that a general exemption can be given by government on the recommendation of GST Council, or a special exemption. Special exemption is given in exceptional circumstances. Plus, whenever you talk about exemption, if the output is exempt, then your input tax credit gets restricted and will not be eligible for ITC. Now, let's talk about the entries. We'll take it up sector wise. Renting of immobile property. There are only 2 exemptions in renting of immobile property. First, if a vacant land is given for agriculture. The term agriculture is defined in the law, which says agriculture includes horticulture, rearing of animals except horses. So cultivation of plants, rearing of animals except horses. Rearing of horses is not covered by agriculture. So vacant land given as a stud farm to keep horses will be taxable. Then the second one is renting of a residential dwelling. For use as residence. So the use also has to be residence, plus it should be a residential dwelling. Twin conditions have to be satisfied. If these 2 conditions are satisfied, then in that case it will enjoy a exemption. This was the plain entry. Then government added except in this entry and said except when given to a registered person. So when residential dwelling is given to a registered person, it will be covered under reverse charge mechanism. They excluded it from exemption because if the exemption would have continued, then there couldn't have been a reverse charge on this. So they said except when given to a registered person. But because of this a problem arose. What about a proprietor of a proprietorship concern taking a house on rent for his personal use? Should GST apply on that as well? Then government added an explanation to this, saying that proprietor for his proprietorship firm and for personal use. Proprietor of a proprietorship firm taking a residential property for his personal use and not for business, then in that case it will enjoy a exemption. This clarification was added. But what if a company is taking it for a director? Then the company will pay the tax under RCM plus exemption is also not available. Then the second discussion is with regard to hiring. See, in hiring there are three exemptions. One, a bus, saying a vehicle designed to carry more than 12 passengers given on rent to a state transport undertaking will enjoy a exemption. Truck, that is a goods vehicle given on rent to a goods transport agency, also enjoys an exemption. And lastly, a electric vehicle given to a local authority, again designed to carry more than 12 passengers, will enjoy a exemption. These are the three basic entries. One entry is related to education, saying that if suppose a school bus is given on rent to a person who is providing transportation and staff faculty, then that enjoys. But it has to be given to a person who is providing transportation and faculty to a education institute up to higher secondary only. Beyond that, the exemption is not available. Then the third entry deals with construction sector. Now, construction sector, the first exemption is for any construction under Pradhan Mantri Awas Yojana if it's a pure labor contract, and it's very wide, it covers repair etc. as well. Pure labor doesn't involve supply of goods, it is basically a service contract. Then construction of a single residential unit except as part of a complex. Careful. Bungalow construction will enjoy a exemption. But if it is part of a complex, that is flats, then GST will apply. Reason is very simple. Big builders construct these flats, they will be capable of collecting GST and paying it to government. Then the last one is infrastructure for electricity to reach farmland. Basically, electric poles being constructed so that electricity can reach the farmland, that also enjoys a blanket exemption. Remember, first two entries have pure labor. The last entry does not mention pure labor. The last entry could be either works contract or pure labor. Both will be eligible for the exemption. Plus, the second one is a bit narrow. Repair etc. is not covered under this. First one covers repair renovation as well, but second one only original works, doesn't include repair renovation. Then we move on to government related services. See, any service provided by government or local authority enjoys a exemption. Is it? Yes. So see, it's very wide. By them enjoys a exemption. To them, if you are providing any service to government, generally it is taxable. But this has 4 exceptions. There are 4 things which are taxable. Let's see what are these 4. One is service provided by Department of Post. Only book post, ordinary post, postal letter where the envelope weighs less than 10 grams, that is exempt. Otherwise, Department of Post, all services are taxable. Then transportation of goods or passengers, This is also taxable. Then talking about an aircraft or vessel related services, it is provided by both government as well as other than government. So government will not get an exemption just because it is government. Otherwise it will lead to giving an advantage to government entities compared to others. Now, whenever we talk about government or local authority here, it only means government departments. LIC is not government. BSNL is not government. These are government companies. We are talking about government departments. These three are taxable under forward charge. Then the law here has said that any service to business entity, any service provided to business entity will be responsible. This is excluding first three limbs, because first three limbs is covered by forward charge. The last one is covered by reverse charge mechanism. Now if you see carefully, first we said that any service by them is exempt. That means it was very wide. Again we are saying any service to them is taxable. How does this make sense? Careful. Here any has one condition, that it has to be provided to a business entity. That means whenever government is providing it to other than business entity, then in that case it will continue to enjoy a exemption except for first three limbs. But any service to business entity, taxable under reverse charge mechanism. Now one more problem arises. This word any was very wide, and government did not intend to cover small services. So they said here, not for first three, if the service value is up to 5,000, then exempt. Small services I don't want tax. Plus, if the business entity is such that its preceding financial year turnover is below registration limit, then also it will enjoy a exemption. But remember, this exemption will not be available for first three limbs. First three limbs will not enjoy this exemption. Plus, the second one is not available to renting of immobile property by government or local authority. That is taxable. Then passport, visa, driving license, birth certificate, death certificate taken by an individual enjoys a exemption. Then government mentioned about registration under any law, testing, calibration, safety check for employees unrequired under any law, or it could be merchant overtime charges, or ERCC. What is ERCC, sir? Excess Royalty Collection Contractor. ERCC is basically appointed by the government to collect royalty on behalf of government from the mining leaseholders. To the extent mining leaseholders has paid the tax under reverse charge mechanism, ERCC gets an exemption to avoid double taxation. To the extent ERCC has paid extra and mining leaseholder has not discharged GST on that, that only will be taxable. So the exemption is restricted to the extent tax is paid on the royalty by mining leaseholder. Then petroleum profit. Now what is this petroleum profit? See, in petroleum industry there are two things: cost petroleum, profit petroleum. First, extraction of petrol, crude oil. When you extract crude oil or natural gas, first you incur some cost. Say suppose 40 crore is incurred as cost. Then you get oil from that and you sell that oil and you earn. So first 40 crores will be called as cost petroleum. That was the cost to bring that petrol. And then say suppose you have totally sold petrol for 100 crores. 40 crores cost petroleum because that was the cost to extract, and 60 crores is called as profit petroleum. Now out of this 60 crores, say suppose government has to get 30% as royalty. Will GST apply on that 30%? The answer is no. Profit petroleum also enjoys an exemption because output of petroleum is not liable to GST. Now on the purchase, if you make royalty taxable, then it will increase the cost of petroleum, and hence government has given a exemption for profit petroleum. Then the law has provided exemption for guarantee commission. Guarantee commission earned by government for guarantees given by them. And when does government give guarantee? For loans taken by public sector undertaking, government gives a guarantee which will enjoy an exemption. The next entry is national permit. Obviously for goods carriages, national permit is given, that enjoys an exemption. Careful, it's only for goods carriage, not for passenger vehicles. Then there are two things where service provided to government enjoys an exemption. One is a function under Article 243G or 243W of the Constitution, which is taken by a government or local authority, provided it is a pure service or a composite supply where goods element does not exceed 25%. So goods should not exceed 25%. That means it is majorly a service contract, not a goods contract. That has to be taken care. Then fair price shop. Fair price shop earn commission or margin. That commission or margin will also enjoy an exemption. There is no GST applicable. So these are the entries which had to come because of this word any. Be very careful with regard to government related services. Then when we talk about education institute, see, education institute, there are three things which qualify to be education institute. One is preschool and up to higher secondary. You are aware of this. Second one is education as part of a curriculum to obtain a qualification recognized by law. Here ICAI, degree colleges, post graduation courses, all these will be covered under this. And third one is any course which is approved by NCVT or SCVT. All those courses being conducted, anyone who is conducting that course will also be called as an education institute. NCVT, National Council for Vocational Training, State Council for Vocational Training. These approved courses will also enjoy an exemption. Don't give an exemption to any vocational training, only those courses which are approved by them. Now, any service by this education institute provided to student, staff, faculty will enjoy an exemption. No GST is applicable. Now coming to the purchase side. Purchase side, transportation, catering, housekeeping, security. Transportation, catering, housekeeping, security. These four services are exempt only when it is category 1 education institute, that is preschool and up to higher secondary. See, education institute giving these services anyways exempt, but taking only first category will get the exemption. Second and third category education institute don't get this exemption. Plus, be careful, housekeeping and security should be within the education institute. If it is provided outside, then exemption is not available. They have complicated it, but be very careful. That's why institute keeps asking on this. Then when we talk about admission or examination related service, this enjoys an exemption for all the three categories of education institute. Printing of question papers, fees paid to paper checkers, completely exempt. Then subscription to online journal, education journal and periodical. This subscription to online journal and periodical, this is exempt only for second category, that is this one, education as part of a curriculum to obtain a qualification recognized by law. That means 1 and 3 will not get this exemption. This is available only for 2, this is available only for 1, but admission or examination related services, everyone will get the exemption. Now some important points. Central and state education boards, CBSE, ICSE, Karnataka State Board, all these are regarded as education institute for the limited purpose of conduct of examination. Plus, National Testing Agency or any authority or board set up by government for conduct of entrance exam are also regarded as education institute for such limited purpose. One is central and state boards for conducting of examination, National Testing Agency and any authority or board for conduct of entrance exam. They are regarded as education institute, so they will also get an exemption. In fact, there is a plain entry as well, conduct of entrance exam by a education institute themselves, not by a board set up by government, but by a education institute, also enjoys a exemption. So this was about education entry. Then coming to transportation of goods. See, when we talk about transportation of goods by road, there is a plain exemption given, but GTA and courier agency will be taxable. GTA wanted an exemption. Government said GTA providing service to unregistered person other than specified person. Specified persons are covered by RCM. So GTA to unregistered person other than specified person, this is exempt. But GTA providing service to registered person or specified person, this is taxable. Now in this case, either registered person or specified person can pay the tax, or if GTA wants, they can also opt for forward charge. An option is given. Talking about rail, except for some goods, everything is taxable. There are few goods rail transportation enjoys an exemption, but generally taxable. Vessel, taxable. Within India, India to outside India to India, all are taxable. Aircraft. Aircraft is also taxable. There is only one exemption. Outside India to India, aircraft transportation enjoys an exemption. This is the only exemption entry in aircraft and vessel. Otherwise, within India transportation, outside India, India to outside India to India, all are taxable. Inland waterways enjoys an exemption. It's not very developed. Within the landmass, river transportation enjoys an exemption. Now, this rail, vessel, GTA, these three categories, for some goods they enjoy an exemption. You can remember it this way. I was reading newspaper and then I heard about India-China dispute. Then say suppose there is a fight, then we'll have to send relief material to those areas. We will also have to send defense equipments. Then there'll be a deficit of milk, salt, food grains. So all that has to be supplied. Food grains come from agriculture produce. Agriculture produce are best when you use organic manure. Careful, this food grain, it also says pulses, flour, rice. Careful. Pulses, flour, rice. But remember all this which I have told you, only rail, vessel and GTA will be eligible for the exemption. Nothing else will enjoy this exemption. So careful about that particular point. Okay. There's one more exemption, GTA, providing services to government department, government authority who have taken registration only for the purpose of TDS enjoys the exemption. Okay. Then coming to transportation of passengers. See, transportation of passengers is a very easy sector. Let me take you through. We'll start with bus. Bus can be stage carriage or contract carriage. Stage carriage, if it is AC, taxable, non-AC enjoys a exemption. Contract carriage also is same, AC taxable, non-AC exempt. But if it is for tourism, charter or hire, then even non-AC contract carriage will be taxable. Now, what is contract carriage? What is stage carriage? Stage carriage are public buses which stop at each stage. People get in, people step down. Contract carriage are normally pre-booked, like Bangalore to Mumbai, Mumbai to Pune. Those are called as contract carriages. Then aircraft enjoys an exemption only for any flight starting or terminating in northeastern states including Bagdogra in West Bengal. Otherwise, it is completely taxable. And remember that exemption is only for economy class. So, economy class, northeastern states including Bagdogra in West Bengal, that enjoys an exemption. Rail, AC and first class is taxable. Non-AC, that is other than first class and AC, enjoys an exemption. Sir, what if it is first class non-AC? First class non-AC will be taxable. It's there in Mumbai. Then vessel. If it is used for public transport, exempt. If it is used as a cruise, then taxable. CBIC has also clarified that when we talk about public transport, it does not mean it is owned by government. It could be owned by private players. Public transport means open for general public. Then auto, metro, monorail, metered cab. All these enjoy a exemption. Tramway also enjoys a exemption. What about aerial tramway, sir? Cable car, ropeway, which are used in tourism sector, that will be taxable. Helicopters, obviously taxable. What about radio taxi or cabs? Only metered cab enjoys an exemption. Otherwise, this is also taxable. Radio taxi is GPS network, Ola, Uber, again taxable. Now, careful about one important aspect, and that thing is metered cab, auto or stage carriage, contract carriage. These three provided through e-commerce operator liable under 9(5) is taxable. If this line was not there, then even if they were provided through e-commerce, they would have enjoyed an exemption. But auto, metered cab and stage carriage, contract carriage will be taxable if it is covered by 9(5). Who will be liable to pay tax in that case? E-commerce operator. Plus regional connectivity scheme airport, any amount which government is paying from viability gap fund will also enjoy an exemption. Then the next sector is agriculture. See, agriculture, any service in relation to agriculture or agriculture produce enjoys a exemption. But be very careful. Government has provided scientific research in agriculture, training to farmers, testing of soil, harvesting, cultivation, various activities carried out on the farmland, renting of farmland, renting of agro machinery, transportation, warehousing, storage, loading, unloading, all these enjoy an exemption. The most important thing is what is agriculture and what is agriculture produce. Agriculture, you already know, cultivation of plants and rearing of animals except horses is covered by agriculture. Agriculture produce is the primary produce on which no processing is done, or such processing is done which is usually done by the cultivator, which does not change the essential characteristic of the product. So rice is not an agriculture produce, but this created a lot of dispute between South India and central government in 2013. In fact, rice is not an agriculture produce, but rice transportation, warehousing, packing, loading, unloading gets a separate exemption. But what about commission agent of rice? Commission agent is not mentioned in the entry. This will be taxable. Now what if all this is related to paddy? If all this is related to paddy, then it will enjoy an exemption because paddy is a agriculture produce. Rice, even though it is not an agriculture produce, government has given a exemption for rice. Okay. Then fruits and vegetables, packing, repacking, labeling, relabeling, ripening, waxing of fruits and vegetables, government has given an exemption. Minor forest produce, warehousing also enjoys an exemption. Bamboo. Then you have cereals, pulses, fruits, vegetables, warehousing also enjoys an exemption. Earlier this entry of warehousing was very wide, but now only 4. What about fumigation in the warehouse, sir? Fumigation in the warehouse where agriculture produce is kept. Earlier it used to enjoy an exemption. Now it is taxable. Then coming to another important entry, healthcare. Now see, healthcare services doesn't matter where it is provided. The question is who is providing it. 3 persons get an exemption: authorized medical practitioner, clinical establishment and paramedics, which is support staff. Authorized medical practitioner, clinical establishment, paramedics, these 3 get an exemption. Anyone else will be liable to GST. Say suppose I start providing healthcare service, though it is illegal, it will be taxable. Only these 3. Doesn't matter where it is provided. Even if the doctor, authorized medical practitioner, is providing it online through an app, still exempt. Even if clinical establishment is sending nurse to the patient's home, still it will be exempt, because these 3 providing services enjoy an exemption. Now government wanted to levy GST on room charges in hotels. They said only room charges, all other elements are exempt. Room charges, if it exceeds 5,000 per day, then it will be taxable. Below that, it enjoys an exemption. But this taxability is not applicable for ICU, CCU, NICU and ICCU. What is this, sir? Intensive care unit, cardiac care unit, intensive cardiac care unit, and finally neonatal intensive care unit. These, even if there is a room charge of 10,000, 15,000, still it will enjoy a exemption. There is no GST applicable. Careful, it has to be in a recognized system of medicine. Ambulance service is one service provided by any person, enjoys a exemption. Last one, cosmetic and plastic surgery. In the exam, be careful. If it is a necessity, then it will be exempt, because if it is for injury, trauma, then in that case exemption is given by government. If it is as a luxury, then it will be liable to GST. In the same discussion, we have charitable trust. First of all, the exemptions are available only if that charitable trust is registered under 12AA or 12AB of Income Tax Act, where they get some benefits. Plus, any service by them is exempt only if there are 4 services specifically. Any service to them is taxable. Which are these 4 services, sir? Public health, care and counseling, rehabilitation centers, that is covered. Second, advancement of religion, spirituality, yoga. Third, education, orphan, homeless, person in rural area age more than 65 years, prisoners, physically or mentally disabled persons, education. And last one, preservation of environment including wildlife. So 4 entries. First, public health related. Second, advancement of religion, spirituality, yoga. Third one, public education. Last one, preservation of environment. Anything other than that will be taxable. Plus, if they don't charge consideration here, then anyways it will be exempt. Then old age home up to 25,000 per month enjoys an exemption. Religious place, giving a hotel, within the religious place precincts, if they charge 1,000 or more per day, then it will be taxable. If they charge 999, then exempt. Then shops in the religious place, if they charge 10,000 or more per month, then it is taxable. This is the only entry in exemption where exactly 10,000 you will not get the benefit. It will be liable to GST. Then 10,000 or more per day for a hall, will be liable to GST. Community halls where marriages are conducted. Panditji getting any amount for conduct of religious ceremony is exempt. Arts and culture, recreational activities related to training programs of dance, drama, etc., that if it is provided by an individual, then it enjoys an exemption. Sports, it has to be a charitable trust registered under 12AA or 12AB of Income Tax Act. Only then exemption will be available. Then there is a exemption for membership fee, which association charge from members. A very wide entry, but the exemption is only for membership fee up to 1,000 per year, not per month, 1,000 per year. Then exemption is available. Then we move on to financial sector. Very important entries. Interest enjoys a exemption. Bill discounting discount also enjoys a exemption. But what about charges? Charges or fee will be liable to GST. Exchange of foreign currency amongst banks or authorized dealers is also exempted. But if it is with general public, then it is taxable. Don't forget, credit card interest will be taxable. And remember one thing, if the underlying supply is taxable, that is if this is taxable, then the other person delays payment of this, then it is interest on delayed payment of consideration for a taxable supply, that will also be taxable. Then there are some miscellaneous entries like arbitral tribunal, advocate, senior advocate. If they are providing service to other than business entity, then exempt. If they are providing to business entity whose last year turnover is below registration limit, exempt. If they are providing to business entity whose last year turnover is more than registration limit, taxable under RCM. Plus advocate to another advocate also enjoys a exemption. Arbitral tribunal or advocate or senior advocate providing service to government or local authority, that is also exempt. Can't expect them to pay tax under reverse charge mechanism, so they have given an exemption to themselves. Transmission and distribution of electricity exempt, toll charges exempt, but annuity payments for making road, earlier it was exempt, now it is liable to GST. Business facilitator, business correspondent, for rural area operations, getting commission from bank or getting commission from insurance company, exempt. In fact, their agents will also enjoy an exemption, but only if it is related to rural area. Then one important entry, foreign tourist. See, if a tour operator is giving service to a foreign tourist, if the tour is wholly outside India, exempt. If the tour is in India, taxable. If it is partly in India, partly outside India, important entry, partly in India, partly outside India, then part exemption to the extent it is outside India. But how do you do the calculation? Based on number of days, and the maximum exemption in this is 50% of total value of tour. So 3 days in India, 4 days outside India for 70,000. How much exemption will you get? Sir, 4 days means 40,000 exemption I should get. No, 40,000 or 50% of this. 50% of this is 35,000, whichever is lower. So you'll be eligible for exemption of 35,000 only. So you'll calculate based on days, proportionate, or 50% of total tour value, whichever is lower. Now, any tour which is for, say, suppose based on hours, and any part less than 12 hours will be considered as half day, and 12 hours or more will be considered as one full day for the purpose of these computations of proportionate exemption. Then we have entries of museum, zoo, wildlife sanctuary, tiger reserve, ancient monuments. Any amount entry fee enjoys an exemption. Amusement facility entry fee taxable. Entertainment events, few entertainment events, and if they charge only up to 500 per person, then it enjoys a exemption. These few are circus, dance, drama, ballet, award function, concert, pageant, sporting event other than recognized and recognized, both are covered, planetarium. These exempt if up to 500 per person. If they charge more, or theatre, etc., will be liable to GST. Plus, the person who is performing, if he is performing classical or folk and charging and up to 1.5 lakh per performance, then it enjoys an exemption. Non-taxable territory to non-taxable territory. How will you catch the person? Government has given an exemption. Non-taxable territory to government or a person other than for business, or section 12AA or 12AB registered entity, then also exempt. But this is not available to OIDAR, because in OIDAR, online information database access retrieval services, even if it is provided to B2C, the person outside India has to take registration in India and pay the tax under forward charge. Then services provided, import of service by an SEZ enjoys an exemption. Transit cargo to or from Nepal and Bhutan enjoy an exemption. प्रधानमंत्री आवास योजना, प्रधानमंत्री जनधन योजना, जीवन ज्योति योजना, वरिष्ठ पेंशन योजना, लाइफ माइक्रो इंश्योरेंस up to 2 lakh rupees. Independent journalist, not guest anchors. Guest anchors are liable. There's a circular on that. But individual independent journalist, public convenience, public library by way of lending of books, they also enjoy an exemption. Earlier, GST network, SEBI, IRDA, these three used to get an exemption. Now it is taxable. But National Center for Cold Chain Development, Employee State Insurance Corporation, Employee Provident Fund, Coal Mines Provident Fund Organization, National Pension System, commission or admin fee charged by National Pension System Trust, RTI information even today enjoys an exemption. Artificial insemination of livestock, except for horses, is also exempt. That's a process which increases the productivity of livestock. Government has given an exemption. Satellite launch services by ISRO, New Space India Limited or Antrix Corporation Limited also enjoys a exemption. So this was the broad outlook of exemption. You go through some of the questions related to exemption. Now let's talk about composition scheme. So basically we use section 10 of CGST Act, where government has given a benefit that a person can pay tax at a lower rate, and when he is paying tax at a lower rate, obviously he will not be eligible for ITC. He will file only one return, GSTR 4, that is annually, and the due date for this is 30th April. And he will pay tax quarterly, and there's a form called as CMP 08, 18th after each quarter. These are the basics with regard to composition, which you can never forget. Then there are two broad areas. One is 10.1 and 10 subsection 2. Second one is 10.2a. So this primarily deals with service industry, but obviously you can also supply goods, not an issue. There is no restriction with regard to goods. This deals with a goods supplier. It could be goods plus some permissible service, or it could also be a restaurant guy, restaurant service provider. Now what's the difference between these two schemes? 10.1 and 10.2, 1.5 crore and 75 lakh is the limit. That is, if your last year turnover was below these limits, then you can opt for composition scheme in the current financial year. 75 lakh applicable to 8 states. You can remember it by MTNM and MASU. Manipur, Tripura, Nagaland, Mizoram. Meghalaya, Arunachal Pradesh, Sikkim, Uttarakhand. These 8 states, if you have a branch, then the limit will be 75 lakh. 10.2a, the limit is 50 lakh. And what is the benefit? In the current year, here you will get the benefit up to 50 lakh. Here you will get the benefit up to 1.5 crore / 75 lakh. and 10 to A, you get the benefit up to 50 lakh. Then are there broad restrictions on goods and service turnover? Here service permissible is 10% of PFY turnover or 5 lakh, whichever is higher. But here there is no such restriction. Careful, this 10% of PFY turnover in a state. That means this has to be calculated state wise. If you have branch in 3 states, you'll have to calculate this 10% and 5 lakh differently. But in the other case, there is no limit which is applicable. Then we have a restriction with regard to common points for both, like a manufacturer of 5 products cannot claim this. Which 5 products? Pan masala, tobacco, ice cream, bricks and tiles, and finally, see, there are various bricks and tiles, and finally you have pan masala, tobacco, ice cream, bricks and tiles. These 5 will not be eligible for composition. But remember, manufacturer. Then let's talk about interstate. Interstate supply of goods or services is not permitted. Then you have casual taxable person and non-resident taxable person. Then if you are supplying non-taxable goods or services, 5 products, alcoholic liquor, again not eligible for composition scheme. Or if you are supplying through e-commerce operator, required to collect TCS under section 52. Again, in that case, you cannot take composition scheme. These are the broad restrictions. Then aggregate turnover. We have written these limits, but what all gets included? Very important terminology. Aggregate turnover includes taxable supply, exempt supply, interstate supply, export of goods or services, but does not include GST and inward supply under RCM. So any purchase anyways will not form, but for clarity, government has clearly provided that RCM, though you are paying the tax, still it will not form. See, turnover basically would mean only sales, any kind of sales. Even if the other person is paying under RCM, any kind of sales will form part of aggregate turnover. Aggregate turnover can never include purchase, can never include GST. It is calculated on a all India basis for all the branches under a same PAN. Plus, for the purpose of composition, interest on loans, deposit, advances earned by Marwadi Gujarati. Now, anyways, any interest on loans, deposit, advances will also not form part of aggregate turnover or turnover calculations in entire composition scheme. Now, what is the rate? See, 10(1) and 10(2), manufacturer pays on 1% of turnover. Trader pays on 1% of taxable turnover. And there is no IGST rate, 0.5 CGST, 0.5 SGST, because you can't do interstate supply. You can purchase from outside the state, but you can't sell outside the state. Restaurant 5%, and then 10 to A, the rate which is given is 6%, that is 3% and 3%. Careful, trader pays only on taxable turnover, while all others pay on turnover in a state, because obviously they will have to pay it separately. If one branch violates one condition, then everyone has to shift to regular scheme. 3 cases where you cease to be a composition taxpayer. 1, voluntarily you can anytime shift to regular scheme. Any condition violated, or the current year turnover exceeds these limits, again you'll have to shift to regular scheme. You give a stock statement which has to be submitted within 30 days. Regular to composition is only permitted on 1st April. Yeah, when you start your business you can take it, but regular to composition only on 1st April. And in case of regular to composition, be very careful on one point. Regular to composition, 60 days you need to submit it, stock statement. Then he will issue a bill of supply, not a invoice. And name board has to mention that he is a composition taxpayer, and that bill of supply also has to mention composition taxpayer cannot collect tax from customers. This is a brief with regard to composition. Be very careful with regard to what is a cost, what is not a cost, because in composition, as you don't get ITC, the tax paid on purchase becomes a cost. Plus this lower rate you have to pay from pocket. You can't collect from customer. These two become a cost. In regular scheme, anyways, nothing is a cost because you collect it from the customer and pay it to government. Tax paid on purchase is also available as input tax credit. So be careful about profit computation in both as to which one is better for a particular taxpayer. Now we are going to revise input tax credit. Now the first thing which you need to be very careful with input tax credit is the meaning of inputs, capital goods, input services. Input means any goods other than capital goods used or intended to be used in the course or furtherance of business. Capital goods means any goods which is capitalized in the books of accounts. Then the wordings is same, used or intended to be used in the course or furtherance of business. So any goods which is purchased can be either inputs or it can be capital goods. Input service means any service, and again the law says used or intended to be used in the course or furtherance of business. Careful, even if it is intended to be used for business, you will be eligible for input tax credit. Now we get input tax of tax paid under forward charge. So any purchases which is under forward charge, will you be eligible for input tax credit? The answer is yes. But to claim input tax, a person has to be a registered person. What about purchases under RCM? Yes, purchases under RCM is also eligible for input tax credit. Plus IGST paid on import of goods is also eligible as input tax credit. So technically you get input tax for all your purchases. It could be purchases under forward charge, purchases under reverse charge mechanism, or import of goods. That is also a purchase where you get the goods from outside India. Now any tax paid under composition scheme is not eligible for ITC. So the 1% which you pay from your pocket, you are not eligible to avail ITC on that 1% which is paid from pocket. Then the word input tax credit is the credit of input tax. Credit of all these things taken together is called as input tax credit. We then move on to the computation mechanism. See, output tax you will derive from all the outward supplies. Never add RCM in output tax. RCM liability is on to be shown separately. Input tax credit will involve all the input tax. It could be purchases forward charge, purchases reverse charge, opening balance of ITC. All this will fall under this basket. And then you will have finally tax payable under RCM. Because tax payable under RCM has to be paid only through e-cash ledger, and hence this has to be shown separately at the end of your computation. So you do output minus input tax credit and then show tax payable under RCM. Never use excess input tax credit which is remaining against tax payable under reverse charge mechanism. Don't mix this computation with output tax. Be very clear with the distinction. The first section which we will deal with is section 16. Now, section 16 deals with conditions to avail ITC. There are totally 6 conditions based on which you can avail ITC. First, you have the invoice, debit note or tax payment document. Possession of the invoice, debit note or tax payment document. Second, receive the goods or services. You should have received the goods or services. Third, supplier has paid tax to government. Now this supplier has paid tax to government is subject to section 41. What is section 41, sir? Section 41 gives us an option, gives us a mechanism saying that it is practically not possible to check whether supplier has paid the tax every month. So what we do is we take input tax credit as self-assessed even if this condition is not checked. So without even checking this condition, section 41 allows, as you have self-assessed, you take input tax credit. Then after the end of the financial year, there will be September. By that time, if GSTR 3B, which is a return for payment of tax and reporting everything, if that is not filed by the supplier, then you will have to reverse the input tax credit by 30th November. And if you don't do it, then interest will start applying after 30th November after the financial year. For instance, if for financial year 20-23, immediately do I have to check whether supplier has paid the tax? No. Then comes September. Due date for September return 20th October. This is 2023. If by that time also he has not filed GSTR 3B, which 3B? For this particular financial year, if he has not filed GSTR 3B till that time, then by 30th November 2023, I have to reverse ITC. So initially when you solve it, can you take ITC at that point of time? Yes. And when do you check whether supplier has paid the tax? You don't check it literally whether he has paid the tax. You just check whether he has filed GSTR 3B for that particular month of the financial year. If he has filed it, well and good. If he has not filed it, then in that case you have to reverse the input tax credit taken by 30th November and interest will start from here after 30th November, that is from 1st December. So this was the third condition. Fourth condition is you have filed a valid return. So registered person should have filed a valid return to avail ITC. Fifth, supplier has furnished GSTR 1 and it is communicated to recipient in GSTR 2B. You learn all this in returns again, but the moment your supplier files GSTR 1, that will get reflected in GSTR 2B of the recipient. Once you can see it in your GSTR 2B, only then you can avail input tax credit. This is not subject to section 41. Careful, this section 41 is only talking about supplier paid tax to government. Then sixth condition, ITC is not restricted under section 38. Now section 38 provides for various cases where system will restrict the credit. In certain cases where system restricts the credit, then in that case you will not be eligible to avail input tax credit. At present section 38, most of the places it says as may be prescribed, and most of those things are not prescribed even today. So technically we don't follow this condition as of now for November 23 exams. Okay. Then there are some additional points like depreciation. If you claim depreciation under section 32 on the GST component, then in that case input tax credit will not be available. If the goods are received in lots or installments, then in that case you can take ITC only after receipt of last lot or installment. Then there is a last date to avail ITC, due date or final date to avail ITC, and the last date to avail ITC is 30th November after financial year or date of filing annual return, whichever is earlier. This is the last date. After that you cannot claim. But remember, this last date is only for invoice and debit note. It is not for tax payment document. So tax payment document like bill of entry, IGST which you have paid on import of goods, you can take ITC anytime. There is no restriction at all. Then if you don't pay your supplier within 180 days from date of invoice, then you will have to reverse the ITC in the month's return in which 180 days expires. You will have to do it along with interest at 18% per annum from the date of utilizing ITC till the date of ITC reversal. This 180 days is not applicable in three cases. Three cases not applicable. First one is RCM case. Where you are paying tax under RCM, don't check 180 days, no need to reverse ITC. Then supply without consideration. If the supply is without consideration, again no need to check. And finally, third party payment. We discussed this in valuation. Third party payment where the supplier says that pay to this third person on my behalf. So recipient is making that payment to that third person. So how will they pay it again to the supplier? Hence government has said no need to check 180 days for three cases. RCM where you are paying the tax, supply without consideration because consideration is not there, and third party payment. Then 5 details which are mandatory to be mentioned on an invoice. If any of these 5 details are not there, you will not be eligible for ITC. What are those 5 details, sir? GSTIN, then you have description, value, GST, and finally place of supply. If out of this any detail is missing, then the person is not eligible for ITC. Plus, where a order is issued in terms of fraud, willful misstatement, suppression of facts, again any tax paid based on that order which is issued for fraud will not be eligible for input tax credit. If there is a bill to ship to transaction, who will be eligible for ITC? You understand bill to ship to? A is sending the goods to C on the direction of B. Who will get the ITC? B will get ITC once the goods or services are received by C, because you are billing to B and shipping the goods to Mr. C. Then we move on to section 17. First we will do section 17.5 block credit. Then we will discuss other points. Now, the first block credit entry is motor vehicle more than 25cc. So up to 25cc you will be eligible for ITC. Normally in up to 25cc you will not get many vehicles, but in exam you can get. So up to 25cc ITC will be available. Motor vehicle which is for more than 25cc will not be eligible for ITC. Okay, so we were talking about motor vehicle. Motor vehicle up to 25cc is eligible for ITC. More than 25cc designed for transportation of passengers, aircraft and vessel. So these three things are blocked. One is motor vehicle, one is aircraft, and the third one is vessel. But say suppose you are using motor vehicle for 3 outward supplies, then you start getting ITC. First one is if you are using it for transportation of passengers, outward supply of transportation of passengers. Be very careful. Outward supply of transportation of passengers. That means you are charging output tax for the service of outward supply of transportation of passengers. Then on that motor vehicle you will get ITC. If it is used for further supply of such motor vehicle, then also ITC will be available. And lastly, if you are into the outward supply of imparting motor driving skill. Same 3 cases are also applicable for aircraft and vessel, but aircraft and vessel have 1, 2, 3, that is these 3 cases, plus they also have transportation of goods. So if an aircraft or vessel is being used for transportation of goods, then also it will be eligible. Plus if it is used for these 3 activities, then also it is eligible. So Indigo purchasing a aircraft will be eligible for ITC. Blue Dart having a aircraft for transportation of goods is also eligible for ITC. Then coming to food and beverages, outdoor catering, life insurance, health insurance, cosmetic and plastic surgery, and renting of motor vehicle. All these are block credit. No ITC on all this. But if it is used for same category of outward supply, then eligible. Say suppose I purchase food and sell food, then ITC will be available. But if I purchase food and give it to my employees as snacks, no ITC is available. Second case where ITC is available in these is where it is basically used for required under a law. If it is required under a law, still ITC is eligible. So if Factories Act is saying that food and beverages have to be provided to employees if the factory has more than 250 employees, then it is required under a statute. Then in that case, will you be eligible for input tax credit? The obvious answer is yes, because the law requires me to do that. As the law requires me to do that, I will surely be eligible for input tax credit. So two exceptions for this. First one, where you are using it for the same category of outward supply, then obviously eligible. Second category, where it is required by the law to provide it to the employee as an obligation. Now, what about repair, maintenance, air insurance of the motor vehicle, aircraft or vessel? Repair, maintenance, insurance of motor vehicle, aircraft, vessel. If motor vehicle is eligible for ITC or aircraft or vessel is eligible for ITC, then you will get on repair, maintenance, insurance of that vehicle as well. Say suppose I purchase a truck for my transportation of goods. I am eligible for ITC on that truck. I am also eligible on ITC for repair, maintenance, insurance of that truck. But if motor vehicle, aircraft, vessel is not eligible, then I will not get on repair, maintenance, insurance as well. So the law is very clear with regard to this particular statement. Now, the third one is travel benefits to employees. Membership of clubs, health and fitness centers. Now this is also denied, but if it is required under a law, then in that case ITC will be eligible. Normally these things are not required under any law, but are you required to know the law where these are required? The answer is no. Question will clearly specify whether it is required under a law or not. These, if they are required under a law, it will be eligible for ITC. What is travel benefits to employees? Basically vacation. Sending the employee for vacation for meeting a target. Will ITC be eligible? The simple answer to that is no. Okay. Then any goods or services used for personal consumption, not eligible for ITC. Any goods or service on which tax is paid under composition scheme, then also it is not eligible for ITC. Any goods or service purchased by non-resident taxable person except goods imported by him. Whatever he is importing, that is eligible. Otherwise, any goods or service purchased by NRTP will not be eligible for ITC. Then any tax which is paid based on section 74, 129, 130. 74 deals with show cause notice for fraud cases and consequent demand order passed. 129 deals with search during transit, and the good part is search during transit there is no tax payable. Tax is separate, only penalty is payable as of now, and confiscation is dealt in section 130. So in these three cases ITC will not be available. 74, 129, 130. Then any goods lost, destroyed, stolen, written off or disposed by way of gift or sample. In all these cases you are not generating output tax. As you are not generating output tax, you will not be eligible for input tax credit. Then construction and works contract. See, any goods, services or works contract which is used for construction of a immovable property is blocked. Then the law says except when it is for plant and machinery. If it is for plant and machinery, then ITC will be available for all these goods, services and works contract. Careful. Plant and machinery excludes certain things. Plant and machinery excludes three things. Now in these three things you will not get ITC because these are excluded from plant and machinery definition itself. First one is telecommunication towers. Second, land, building, other civil structure. And last one is pipeline outside the factory. Pipeline within the factory you will get ITC because that's plant and machinery, but pipeline outside the factory is not considered as plant and machinery. You will not be eligible for ITC. So these three things are excluded from plant and machinery, hence not eligible. Plus, what about a contractor? Say suppose he is purchasing goods and services and providing works contract, or taking works contract, giving works contract, or taking goods and services, providing construction. Yes, if you are engaged in same category of outward supply, then in that case it is eligible, because obviously it is not on his own account, he is providing service to someone else. That is obviously eligible for ITC. Okay. Then we move on to section 17, other points. 17.5 deals with block credit. Balance section 17 deals with apportionment of ITC. Now, apportionment of ITC basically tries to tell us what should you do for each type of purchase. See, say suppose a purchase is used only for exempt supply. You think if you are using a purchase only to make exempt supply, will you be eligible for ITC? The answer is no. Purchase which is only used for exempt supply. I purchase raw material, output is exempt. Will I get ITC on that raw material? No. If it is only used for non-business purpose, wonderful. If a purchase is only used for non-business purpose, again you will not be eligible for ITC. If it is used for only taxable supply and zero rated supply, then in that case it will be eligible for ITC. Sir, what is zero rated supply? Zero rated supply are two transactions: export and supply to SEZ unit or developer for their authorized operations. If for these two things you are using any purchases, that means you are supplying it to SEZ. Now, in that case, you will be eligible for ITC of your purchases, because zero rated supply, that is export or supply to SEZ, is such a powerful transaction that you start getting ITC even if you are not paying any tax on output. Zero rated supply is heaven. Don't be confused between nil rate and zero rated supply. Nil rate is equal to exempt supply. You don't get ITC for this. Zero rated supply is not a rate, it's actually a transaction, and two transactions. First transaction is export, second transaction is where you are basically trying to sell it to a SEZ unit or developer, and then SEZ unit or developer will export. So government has given a benefit of zero rated supply. Then comes common credit. Common credit meaning those which are used for exempt supply as well as taxable supply. Now common credit, you need to be careful. See, if common credit is related to input and input services, then the treatment is different. If it is related to capital goods, then the treatment is different. Let's talk about input services first. If common credit is used for input and input services, first find out how much is relatable to exempt supply. How will you find out that? Common credit into E by F. E is exempt supply plus supply where recipient is paying the tax under RCM. Careful, supply where recipient is paying the tax under RCM. For example, I am an individual direct selling agent. Who is responsible to pay the tax? Bank or financial institution. I providing services to bank. For me as an individual direct selling agent, it will become E, because this is a supply where recipient is going to pay the tax. For me, it will be regarded as E. For R, sir, for recipient it is nothing. For recipient it is purchase. People, we are seeing exempt turnover divided by total turnover. Turnover is always from the angle of supplier, not from the angle of recipient. So for this supplier, if we are doing a computation, this will become E. E excludes negative list other than land and building. Second, advantage Marwadi Gujarati, interest on loans, deposit, advances other than interest earned by banks and financial institution. So for banks and financial institution, interest is E, but for others, interest is not considered as E. Which interest? On loans, deposit, advances. Then duty credit scrip. Duty credit scrip, when you sell those duty credit scrip, that is also not part of E. And then there is vessel transportation of goods from India to outside India. This earlier was exempt, but now it is taxable. So it does not have any implication because it is not E, as it is a taxable supply. Remember, taxable supply will never become E until and unless recipient is paying the tax under reverse charge mechanism. F is total turnover, which will include everything. Don't forget, 1% of securities value will become part of E as well as F. Sale value into 1%. Though securities is neither goods nor services, but for the purpose of E and F computation, 1% is considered. Land and building will always be valued at stamp duty value. Then, how do you find out how much is relatable to non-business purpose? Now, relatable to non-business purpose, government has said common credit into 5%. But people, please don't apply this 5% always, even if non-business purpose is not mentioned in the question. This you will apply only when non-business purpose is mentioned in the question, plus specific percentage of how much of non-business purpose is not given. Say suppose they tell you 1/3 is used for residence, then you directly disallow 1/3 because you know that 1/3 is used. Say suppose non-business purpose is not at all mentioned in the question, then you don't start applying 5%. You will apply this 5% only when non-business purpose is given plus proportion of non-business purpose is not available. Then common credit into 5%. And then balance common credit will be eligible for ITC. This you will do on a monthly basis. And at the end of the year, you will do a final computation for the entire year. If you have reversed more, then you will take back that ITC. If you have reversed less, then in that case you will have to reverse ITC. For this monthly and yearly computation, government says do it by 1st April of the next financial year, and last date for doing it is even today due date for filing September month return or date of filing annual return, whichever is earlier. Here 30th November has not been changed even today. Then coming to capital goods. Common capital goods. See, common capital goods. First, step 1 is you take full ITC in the month of purchase. Oh, full ITC will take, sir. Haan. Say suppose you have paid 60,000. You take full ITC. Then you divide by 60 because you will find out by the credit attributable to 1 month. Why 60? Because life of capital goods is taken as 5 years. 5 years is nothing but 60 months. So you will divide it by 60. So credit attributable to 1 month is 1000. Once you get this 1000, this is for one capital goods. There might be so many capital goods. You will combine all of those and then you will do the reversal on a monthly basis. Every month you need to do reversal. How do you do that reversal? TM is what you have derived in step 2. TM for all the capital goods, credit attributable to 1 month, TM, into E by F. And say suppose you want to directly do on 60,000, then 60,000 divided by 60 into E by F. That also can be done. So if total figures are given, total it, then divide by 60 once and multiply with E by F. Exempt divided by total. But E here is much wider than exempt. It will include exempt, supply where recipient is paying the tax, exclude something, don't forget to add 1% for securities, sale, and land and building will always be valued at stamp duty value. Okay, then you continue this reversal for 60 months, but do it only of proportion of 1 month. See, TM will not change. There might be new TMs, but TM of a particular asset will always be same, 1000. E by F will keep changing because E by F is based on per month computation. Here we are not required to do a final computation after the end of the year because anyways we are doing it on monthly basis, dividing it by 60. This is how you deal with common credit. Then the law says banks and financial institution have a special option which they have to select in a financial year. Once they select an option, they can't change for the financial year. What are the options, sir? First option, you reverse 50% of ITC on inputs, capital goods and input services. Reverse 50%, take balance 50% ITC. This is option 1. Option 2 is follow proportionate reversal. That means keep doing E by F. Which is simpler? First one is simpler. Which is good? First one is good. Because banks and financial institution, most of their income is interest, and interest earned by banks and financial institution is E. So if you do proportionate, you lose more ITC because 75% to 80% of bank's income is interest, which is an exempt supply. And that's why 50% is beneficial plus 50% is opted in real life. However, the law very clearly says once you opt for it, you cannot change for the entire financial year. Okay, great. Then you have one very important topic is when there is a change in usage of capital goods. See this carefully. People, earlier the capital goods was used only for exempt supply. Now it is being used for taxable supply. Will you get ITC? Yes, you will get ITC. How much ITC will you get? Tax paid at the time of purchase minus 5% per quarter or part of the quarter. This is what you will get as ITC. Say suppose you have used it for 4 months, then 2 quarters. But careful, quarters are always to be calculated based on Jan to March, April to June, July to September, October to December. Part of the quarter is considered as full quarter. So you will compute this and that much ITC can be taken. Earlier if it was used for taxable supply, now you use it for exempt supply. What will you have to do? You will have to reverse ITC. How much of ITC will you reverse? Proportionate to remaining life of capital goods in months. Don't forget, this is in months. So say suppose you have used it for 5 months. 5 months you have used it for taxable supply, but you would have taken full ITC at the beginning only. 55 months credit should be reversed now because next 55 months you are going to use it for exempt supply. These two are easy cases. Then what if earlier it was used for exempt supply, now it is being used for both? See, Earlier when it was used for exempt supply, you wouldn't have taken ITC at that point of time, correct? That time you wouldn't have taken ITC. First step is take ITC. Full sir, full. Take ITC. Then you reverse for the period for which it was used for exempt supply. So say suppose you have used 3 quarters, then for those 3 quarters you have to reverse, because that time you were using only for exempt supply. Then start monthly reversal. Start monthly reversal, because now you are using it for both. Start monthly reversal, but monthly reversal you will do for full life or remaining life? Remaining life. But sir, how will we do this computation? See, this, say suppose it was 60,000. Now 3 quarters, so 60,000 into 5% into 3 quarters. This much you have reversed. 3 quarters gone, 51 months left. 51 months you have to do the reversal. How will you do it? 60,000 divided by 60 into E by F. This you will do for 51 months. Careful, don't use 51,000 by 51. Full credit divided by 60, because denominator is always to be divided by 60. You don't have any other option. 60,000 by 60. This computation of E by F you will do for remaining life, that is 51. Careful about this particular thing. Last one is going to be simple. Earlier used for taxable supply, now used for both. See, earlier when it was used for taxable supply, you would have already availed ITC. Now when it is being used for both, then in that case you will only start monthly reversal. That's it. That's it. Start monthly reversal. And how will you do this monthly reversal? Whatever tax you paid at the beginning, divide by 60 into E by F, and again you will do it for remaining life. Here step 1 and step 2 is not relevant. Directly step 3 comes. Because earlier you would have taken ITC, and whatever you took ITC for that period where you were only using it for taxable supply, you have validly taken ITC, so no problem at all. Now for these first two, or sorry, only for first one, here if the asset is older than 1 year, then you will not get ITC. Reversal, sir, reversal you have to do even if it is older than 1 year. This also even if it is older than 1 year. This also even if it is older than 1 year. Exempt to taxable, 1 year criteria is applicable. So this was about section 17. Now coming to section 18, special circumstances. Say suppose you are under composition scheme, now you are taking regular scheme. So earlier you were under composition scheme, now you are opting for regular scheme. Government says that you are going to pay me more taxes, I will also give you something. So whenever you are shifting from composition to regular, you can take ITC on stock of inputs and capital goods. Stock. When stock on the day preceding the date of shift. Preceding the date of shift. So preceding the date of shift, you can avail ITC. Inputs, you can take full ITC of the tax which you have paid at the time of purchase. Capital goods, tax paid minus 5% per quarter or part of the quarter. And remember, 1 year criteria is applicable here. If it is older than 1 year, you will not get ITC. So you cannot take ITC on stock. Now let's think about regular to composition. See, regular to composition, you are going to pay 1% to government. Government says here on this stock, which is immediately preceding the day, you have to reverse ITC. Inputs, you have to reverse full ITC, which you had taken earlier. Capital goods, proportionate to remaining life of capital goods in months. That 55 months left, 55 months you do the reversal. Here 1 year is not applicable, because obviously even if it is older than 1 year, government says let reversal come, that should come to me. Exempt to taxable, I have already discussed with you. You'll get ITC. Inputs you'll get full, capital goods you'll get tax paid minus 5%, and 1 year is also applicable. Taxable to exempt is same as this one, you'll have to reverse ITC. Then new registration. Do you get ITC in case of new registration? The answer is yes, if you apply within 30 days from date when a person was liable to register. Then in that case, the effective date of registration is date when you were liable to register, and preceding to this date you will get ITC. Careful. If you apply within 30 days from the date when you are liable to register, then the effective date of registration is the day when you are liable to register. So previous day's stock will be eligible for input tax credit. Okay. Then if you are taking voluntary registration, then the effective date of registration is grant of registration. Whenever registration is granted to you, that day will be the effective date. Preceding to this date also, whatever stock you had, you will get ITC. Here on stock, you get ITC only of inputs, and 1 year criteria is applicable. Capital goods you will not get. Don't forget. New registration is very strict, capital goods you don't get. Sir, what if exempt to taxable, but while I was doing exempt supply, I was not registered? Then can I take ITC on capital goods? No, because then you will apply this provision. Which provision? This one, new registration. Exempt to taxable you can apply only when you are registered. If you are taking a new registration, then you have to go by this provision where you get ITC only of inputs, not of capital goods. No ITC on capital goods, sir. New registration, no ITC on stock of capital goods. After the effective date, whatever you purchase, inputs, input services, capital goods, for all that you'll get. Sir, what if I apply after 30 days? If you apply after 30 days, then the effective date is grant, but before that you will not get any ITC. After that, whatever you purchase after the effective date of registration, that is not a stock, that is actual purchases. That input, capital goods and input services will be eligible for ITC to that particular person. Okay. Then, sir, transfer of business. Can I transfer the E-credit balance of input tax credit? A sold business to B. Can A transfer ITC balance in E-credit ledger? The answer is yes. Permitted. The law does not stop you. In case of sale, merger, amalgamation, demerger, if there is a transfer of business, then in that case, ITC balance also can be transferred, provided, be very careful, liability also should have been transferred. All the assets and liabilities, assets anyways, the government has not mentioned because someone will buy assets only, but liability should also be transferred. In case of demerger, you will transfer it based on turnover, or will you transfer based on assets? Which one will you use? Demerger, there are two entities. So A, B Limited is broken into A Limited and B Limited. Now there was ITC lying in AB Limited. This ITC, can you transfer to both A Limited and B Limited? Yes. Based on what? Turnover or assets? The law says assets. The proportion of assets. So if 40 crore asset went here, 60 crore asset went here, then the ratio will be 4:6. And this has to be done state wise, because obviously SGST of Karnataka cannot be transferred to SGST of Maharashtra. So this has to be done state wise. Be careful about this particular segment. Then, sir, what if I sell capital goods or dispose capital goods? Should I pay tax? Yes. Tax on transaction value or tax paid minus 5% per quarter or part of quarter, whichever is higher. Now, section says use a percentage, but rule says that this can be done as proportionate to remaining life. Institute accepts both the answers. So instead of this, you can also use proportionate to remaining life and compare it with tax on transaction value. Don't change that. Tax on transaction value is same, but tax paid minus 5% or proportionate to remaining life, and then you will do a whichever is higher. That much amount you have to pay to government whenever you sell or dispose capital goods. But if it is molds, dies, jigs, fixtures, then these have a very limited life. Refractories have a very limited life. Refractory is for making that iron and steel manufacturing plant, because it can sustain a temperature of 1000 degrees Celsius. So these, if it is sold, then you will just pay tax on transaction value. Sufficient, sir? Yes. If you are selling molds, dies, jigs, fixtures, refractory, bricks, these things, if you are selling it as scrap, then in that case you don't have to do this computation. Why? Because these don't have a life of 5 years. So simply, why should I reverse, though it does not have a life of so long? So if I sell it for 1000 scrap, then in that case I can pay tax on transaction value for these things. That's a separate benefit which is given in section 18. Okay. Then we move on to section 19, job work. Can a job worker claim ITC? Sir, a job worker will claim on his purchases, sir. Okay. What if some goods is sent by principal to job worker? Then can principal continue to take ITC for that? The answer is yes, no need to reverse. But the condition is inputs should come back within 1 year, plus an extension of 1 year is given. Capital goods should come back within 3 years and an extension of 2 years is given. By these extensions are given by commissioner. So if these don't come back within this time, then principal to job worker will be regarded as a supply and you will end up paying tax on this. So small section 19 just says that if inputs are sent to job worker, principal can avail ITC, but he has to get back the inputs within 1 year and capital goods should come back within 3 years. If it does not come, then principal to job worker, this is regarded as a supply. When we discuss job work in detail, that time I will make you revise that particular point. Now from where does 1 year and 3 year start? See, 1 year and 3 year, if principal is sending, then the day when he sends it, from there 1 year will start. If it is a bill to ship to transaction, like A has directly sent it to the job worker and billing is done to B, billing is done to the principal, then 1 year will start from the date when job worker has received those goods. Careful, Careful. If principal is sending, 1 year, 3 year is counted from the date when principal sends it. But if someone else is sending bill to ship to transaction, then the day it is received by the job worker. Clear? Okay. Then we have section 20. See, section 20 basically deals with input service distributor. Input service distributor is an office of the registered person which receives invoices of input services. Say suppose CA service invoice, which is used for the entire firm. There could be different units, one in Maharashtra, one in Karnataka, one in Kerala. So what does ISD do? ISD, you have to take a separate registration, input service distributor. They will receive these invoices for input services and then distribute it to various units. Maharashtra, Karnataka, Kerala, based on the preceding financial year turnover. If preceding financial year turnover is not available, then previous quarter turnover will be used and the credit will be distributed to all the units. Eligible and ineligible credit has to be distributed separately, but both will be distributed. Even if the receiving unit is only doing exempt supply, still you will have to distribute. Thereafter they will not take ITC, that's a different question, but distribution is mandatory to be done by the ISD. ISD cannot keep anything by itself, it cannot distribute excess. Plus, if ISD is in Maharashtra, then C, S or I to Maharashtra will be distributed as C, S or I respective taxes. But if they have to distribute to Karnataka and Kerala, then C plus S will be distributed as I will obviously be distributed as I. If you are distributing outside the state, then you cannot distribute Maharashtra C plus S to Karnataka. So you will distribute it as I. So ISD is a magical unit. It can convert C plus S on an input service to I when it is distributing outside the state. What about credit note, sir? Credit note will also be distributed. That will lead to negative input. And if there is credit note distributed, then these units have to reverse that much input tax credit. It will be distributed based on original invoice. If that is not given to you, then use preceding financial year turnover or previous quarter turnover, whichever information is available with us. Now, if credit of a particular service is used by everyone, then you will distribute to everyone. But if it is used only by Maharashtra and Karnataka, then you will distribute only to Maharashtra and Karnataka. If it was used only for Maharashtra, then you will distribute only to Maharashtra. So that is also given in the law. Section 21, which is the last section, here deals with a particular case where, say suppose you have distributed excess, then from whom will the recovery happen? ISD distributed excess to the units. From whom will recovery happen? Law says recovery will happen from the recipient units along with interest under section 50. So it's very clearly given that recovery will always happen from the recipients who have received the credit, not from the ISD. Okay. Careful about some key points. C plus S of a state, you will not get ITC in another state. Be careful with the definition of E. You need to be very smart at that. Block credit, normally and generally a question is asked in block credit. Careful about the order of utilization, which we discussed initially. IGST with I, thereafter again C and S, any order, any proportion. C with C, C with I, S with S and S with I. Order of utilization is something which you need to be very strong with whenever it comes to input tax credit question, and this is where you can start solving case study based MCQs as well, because you complete one particular segment of computation the moment you touch input tax credit. Now let's talk about registration. Now you take registration for a place of business. Place of business could be additional place of business or principal place of business. Principal place of business is the place of business declared as principal while taking registration, or other places of business within the same registration are called as additional place of business. You get GST IN, which is a 15-digit PAN based alphanumeric code whenever you register under GST. First 2 digits represent state code, next 10 digits represent PAN, 13 digit is the number of registrations in that state. First one will have 1, second one will have 2, and so on. 14th digit is Z, and last one is basically a system generated number. Then place of business is where the business is carried on and includes a godown, warehouse where the goods are stored or goods or services are received or supplied from. It also includes place of business of an agent from where you are making the supply, and lastly a premise where books of accounts are kept. Now the most important segment in registration is section 22, which deals with persons liable to register, section 23, which deals with persons not liable to register, and section 24, which deals with compulsory registration. You should know all these three together: 22, 23, 24. Liable, not liable, compulsory registration. The first person who is liable to register is a person whose aggregate turnover exceeds specified limits. And what are these limits? 10 lakh, 20 lakh, 40 lakh. For goods, 10, 20, 40, and for goods plus services or only service, it is 10 lakh and 20 lakh. Remember, this is calculated on an all India basis and it is for a financial year. It excludes GST, it excludes inward supply under RCM. Second one, a person who was registered under the earlier law. Third, earlier law meaning service tax, CST, VAT. If you were registered in that law, government said come in GST as well. Third one is transferee in succession. And last one is transferee in amalgamation. There's one difference between the two. Transferee in succession, the law says only if the transferor was registered, then only transferee is required to register. So if A sells his business to B, if A was registered, B has to register because he is succeeding the business. If A was unregistered, B is not required to register. But transferee in amalgamation, such thing is not mentioned. So transferee in amalgamation has to register. One more factor might be because companies would normally be registered, there's a lot of RCM liability on them, so normally they would be registered. So if they are going for amalgamation, demerger, merger, then obviously the transferee, that is the new entity, has to register. Then comes section 24, a person doing a interstate taxable supply of goods. not services. Services get a relief. Interstate taxable supply of goods, mandatory registration. If you are selling outside the state, you need to register mandatorily. Second one, if you are a person liable to pay tax under RCM. So if there is a RCM liability on you, mandatory to take registration. Third one, so this section 24 overrides this 22(1). Even if the limit does not get crossed, still in section 24 cases you have to register. E-commerce operator where TCS is applicable under section 52. Any government department etc. where TDS is applicable under section 51. ISD, input service distributor. OIDAR, what is this OIDAR, sir? Online information database access retrieval services provided to unregistered persons in India. So then OIDR who is outside India has to take registration mandatorily. Then a person supplying goods or services through e-commerce operator which is required to collect TCS under section 52. Here we are talking about the person who is supplying through the e-commerce operator, seller on Flipkart. So that seller on Flipkart will have to register mandatorily. Then agent. Who is this agent, sir? This agent is agent covered by Schedule 1. Which Schedule 1, sir? Supply without consideration, where agent is billing in his own name. Where the agent is billing in his own name, then such agent, government has said, you have to register mandatorily. Then you have CTP, casual taxable person and non-resident taxable person. We'll discuss it in this segment only. Casual taxable person, non-resident taxable person making taxable supplies. Section 23 gives benefit, saying that persons are not liable to register. What are the cases where persons are not liable to register? If you are only supplying exempt goods or services. Now, if you are only supplying exempt goods or services, your output will be zero, input tax will be zero. What will you do taking registration? So government has said no need to register. This will override section 24 also, because 23 is giving a benefit even if the limit is more than the turnover, then also they are not required to register. Example, doctor 70 lakh turnover, is he required to register? No, because he is covered under section 23. If you are only supplying goods or services covered under RCM. Now if you are only supplying something which is covered by RCM, then the recipient has to pay the tax. Supplier will not be required to pay the tax because recipient has to pay the tax mandatorily in RCM. So for the person liable to pay under RCM, mandatory registration, but for the supplier no need to register. Like insurance agent to insurance company, insurance agent mandatory, insurance company government has, insurance agent no need to register, insurance company mandatory registration. Then the third segment is agriculturist. It has to be an individual or HUF for cultivation of land. Careful, only cultivation of land, not rearing of animals. Agriculturist, farmer also gets a benefit only with respect to cultivation of land. If he is doing that, selling tomatoes, potatoes, no need to register. Fourth one, supplying services through e-commerce operator up to 10 lakh, 20 lakh. This is a benefit. See, here government has said that if you are supplying through e-commerce operator, mandatory registration. But services get a relief up to 10 lakh, 20 lakh, no need to register. Sir, what if these services are those which are covered under 9(5)? Let me talk about it. 9(5), eco fee is required to pay under 9(5). Like Ola, Uber. Ola, Uber has to mandatorily take registration. Now will supplier be required to take registration? No, these are obviously services other than 9.5, because in 9.5 anyway supplier is not required to register if it is covered under 9.5. But if it is housekeeping or accommodation, then if supplier is registered, then no 9.5. Careful with this, be very careful. If 9.5 case, eco is responsible to pay the tax, then the supplier is not required to register. But if supplier is registered in housekeeping and accommodation, then there is no 9.5 na. Then 9.5 is only not there. Then in that case, eco will not be liable to compulsory registered, because supplier is registered and it is not a case of 9.5. Sir, but what if Ola driver is registered? People, Ola driver, if it is registered, it doesn't matter, because for transportation of passenger and restaurant, eco has to pay the tax mandatorily. They don't have an option. Housekeeping and accommodation are the problematic areas, because their government says if supplier is liable, then no 9.5, because then supplier will discharge the tax. But that is not there in transportation of passenger in restaurant. Careful. Then lastly, we have interstate handicraft goods. Interstate handicraft up to 10 lakh 20 lakh, and these are notified handicraft goods. You are not required to know what is notified, they'll give you in the question. But notified handicraft goods, even if it is interstate, see, because here interstate is mandatory, but here government is saying even if it is interstate, no need to register. So if we understand interstate, if you are doing services, then you will check 10 lakh 20 lakh. If you are doing goods, and if it is handicraft goods, then again you will check 10 lakh 20 lakh. If it is other goods like laptop etc., mandatory registration. This is how the picture looks. Same way, if you are supplying through eco, goods, then in that case mandatory registration. If you are supplying services, then if it's a 9.5 service, if it's 9.5, then eco will register, you don't have to worry. If it is others, then you check 10 lakh 20 lakh. This is how it looks. So this was 22, 23, 24. 24 is stronger than 23. 24 is stronger than 22. But 23 is stronger than 24. So if you are covered under 23, no need to register, even if you are getting covered under 24, because 23 is giving a benefit, advancing a benefit, harmonious interpretation. 23 will win over 24. Okay. Then we have section 25. What is section 25, sir? Section 25 deals with procedure for registration. Now procedure, some key points which can be asked in exams. See, if you opt for Aadhaar authentication, you need to complete it within 15 days. First, what will you do? Enter PAN, mobile number, email ID. Mobile number and email ID will be auto-generated based on the PAN. This is the amendment which has been made. Systems are not upgraded, but this is what you will write in the exam. The moment you enter the PAN, mobile number and email ID will be fetched from CBDT database, Central Board of Direct Tax database. Then you will receive OTP. Then you move on to part 2. Part B, you get a TRN, temporary reference number. After that, you proceed with the application, fill up all the details and opt for Aadhaar authentication. You get a ARN after completing Aadhaar authentication, application reference number. Then it is forwarded to proper officer. Now if you don't opt for Aadhaar authentication, ARN will be generated automatically at that point of time. If you opt for Aadhaar authentication. Then once you complete Aadhaar authentication, then ARN will be generated. Then it is forwarded to proper officer. If he is satisfied, good. If he is not satisfied, he will issue a notice. And you have to reply to that notice within 7 working days. Then again, if he is satisfied, he will grant the registration. If he is not satisfied, then he will reject the application. Now, can he literally sit on the application? The answer is no. Because once ARN is generated, he has 7 working days time to either issue a notice or grant registration. If he does not do anything in 7 working days, then deemed registration. Oh, is it, sir? Yes, deemed registration. 7 working days is replaced by 30 days. This is important. In 4 cases. First one, not opted for Aadhaar. That means if you don't opt for Aadhaar, then first physical verification will be done of the premise, then they will grant registration. So physical verification will take time. If you opted for Aadhaar but did not complete it, you opted but did not complete within 15 days, then where proper officer deems it as a fit case for doing physical verification before grant of registration. If proper officer feels that physical verification should be done before grant of registration, then obviously 7 will be replaced by 30 days because physical verification will take time. And remember, this has to be approved by ACDC, Assistant Commissioner, Deputy Commissioner. And the last one is where the system based on data analysis and risk parameters finds that this is a risky case. In the same place, lot of people are taking registration. This might be fake registration cases where system themselves pick that up. Again, 7 working days is replaced by 30 days. This is a new point. Plus, government is also starting with biometric Aadhaar authentication along with submission of documents, where copy of the documents has to be physically taken to the facilitation center and shown. This has started only for Gujarat as of now for November 23 exams. Thereafter it has come for Puducherry also, but for November 23 only for Gujarat this particular provision is applicable, this biometric Aadhaar authentication. In this, what will happen is you will have to go and do the Aadhaar authentication in front of the officer, plus you have to show the Aadhaar card, then you have to show all the documents, then ARN will be generated. Only when you complete the biometric process, thereafter application reference number will be generated, then officer will have time of 7 working days. Can he do a physical verification, sir? Yeah, he has these 4 options. In these 4 cases, anyways, he can do physical verification. 7 working days will be replaced by 30 days. Now, once you reply, here also 7 working days is there. But this 7 working days is not replaced by 30. Only first one is replaced by 30, not the second one. Second one even today is 7 working days after you reply. Okay. The time limit for applying for registration is 30 days. If you apply within 30 days, then the effective date of registration is liable date. If you apply after 30 days, then the effective date of registration is grant of registration. This is also given in the law. Officer has a power to grant suo motu registration if he finds that a person who is liable to register has not taken registration, then suo motu registration can be granted by the officer. SEZ unit or developer, even if they have a registration in the same state, they have to still register separately as a SEZ unit or developer. UN or embassy will not take a GST number, they will apply for a UIN, unique identification number, because their output is not liable. they take UIN only for their purchases. Whatever tax they have paid on purchases, they will be eligible to take a refund. So that's why they take unique identification number. Plus, you already are aware of voluntary registration. Anyone can take voluntary registration. Section 26 deals with deemed registration, which will normally not be asked. If you have taken registration under CGST Act, it is deemed to be registration under SGST Act. 27 deals with CTP and NRTP. Casual taxable person, non-resident taxable person. Who is a CTP? A person who occasionally carries out transaction of supply of goods or services in a state where he does not have a fixed place of business. So he undertakes the supply transactions occasionally in a state where he does not have a fixed place of business. So say suppose I am registered in Gujarat. In Karnataka I go to sell in an exhibition. Go to sell, not just to show. Go to sell in the exhibition. Then in that case, in Karnataka, I don't have a fixed place of business. Still I can take registration as a casual taxable person. Non-resident taxable person is a person who undertakes transactions involving supply of goods or services and does not have occasionally and does not have a fixed place of business or residence in India. He does not have a fixed place of business or residence in India. Then he can take registration as a non-resident taxable person. Both compulsory registration plus GTA to CTP. CTP has to pay the tax under reverse charge mechanism. These two cannot opt for composition scheme. And lastly, NRTP, that block credit. Only on import of goods he gets credit, otherwise he does not get input tax credit. Okay, now there are 5 points which are common points. First, you have to deposit in e-cash ledger the tax in advance. Obviously based on estimate, but you have to deposit it in e-cash ledger. So whatever you deposit in e-cash ledger, that you can use to pay your liability while filing GST returns. But initially you have to deposit. You have to apply for registration at least 5 days prior to the commencement of business. Now prior to the commencement of business you have to apply. Normal you get 30 days after you are liable. Here 5 days prior. Then cannot start business unless registration certificate is available. If you don't have the registration certificate, you cannot start your business. So only after that you can take registration. Fourth, validity. Validity is 90 days or days mentioned in application, whichever is lower or whichever is earlier. So say suppose you want registration for 5 days, can you take it? The answer is yes. Extension, can you seek an extension? The answer is yes. One extension of additional 90 days. So total can never cross 180 days. CBIC has also said beyond 180 days we will not give CTP and NRTP. 180 days is 6 months. If you have been working for so long in that place, please take a regular registration there. How much you have to deposit? Gross liability, that is output or output minus ITC. CBIC has clarified output minus ITC. NRTP may not have a PAN. If he does not have a PAN, then he will take registration based on passport number or registration number in the other country. That's how you can take registration. CTP and NRTP important for case study based questions. Then you have section 28. Section 28 deals with amendment. Now, if there is a change in the particulars of the business, then those have to be reported to government. See, the law has divided amendments into core areas and non-core areas. Sir, what is core and what is non-core? Core, there are three areas: name, address, and additions or deletions of partner, karta, trustee, etc. These are considered as core areas. You add a partner, you have to report it as core area. Now, what's the difference, sir? Core area, you will file the application within 15 days. Non-core area also, you will file the application within 15 days of the change. But non-core area, the moment you file application, it is approved. I mean, there is no requirement of officer to approve it. Automatically system gives a approval, and that change is reflected in your registration immediately. Non-core area. So anything other than these three are considered as non-core areas. Here in core area, what happens? You file the application, it is forwarded to proper officer. Then if he is satisfied, then he will accept. If he is not satisfied, then he will issue a notice, show cause notice. Then we will get 5-7 working days to reply. And then again, if he is satisfied, then he will accept. If he is not satisfied, then he will reject the application. So this is the process. Now here in the first leg, once it is forwarded, once you file the application, officer gets 15 working days to either accept or issue a notice. And in the second leg, once you reply, he gets 7 working days. So in registration, it was 7 and 7, and first 7 can be replaced by 30 days. Here it is 15 working days and 7 working days. Okay. Whenever there is a change in PAN due to proprietorship becoming partnership, partnership firm becoming company, company changing it to LLP, then in that case, you will have to cancel the old registration and apply for a new registration, because registration is based on PAN. So earlier registration has to be cancelled and fresh registration has to be applied for. Section 29 deals with cancellation. Now cancellation, two parts. First, a person can make an application for cancellation. Second, suo motu by officer. Is it, sir? Yeah. Officer can also initiate cancellation proceedings in some cases. Now, application. Where can a registered person file an application saying that he wants to say bye-bye to government? The first case where cancellation can be applied is discontinuance of business. Obviously, if there is a discontinuance of business, then you can apply for cancellation. Second one is change in constitution of business. Change in constitution is changing the nature of business, like proprietorship to partnership, partnership firm to company. And third, a person who is no longer liable to register under section 22 or 24 of CGST Act. If he is no longer liable, he can apply. And voluntary registration wants to opt out. So you took voluntary registration, but now you are not happy with the law. I mean, don't want to pay the chartered accountant so much, you don't want to comply so much, you can say a bye-bye to government. Now officer can cancel it when there is a contravention. There are various contraventions which are mentioned in the law. First contravention which is mentioned is, basically you are supplying invoices without goods or services. That means you are only supplying invoices so that the other person takes ITC. Second one, carrying business from a place other than registered place. Third, mismatch between 1 and 3B. GSTR 1 and 3B mismatch, officer can cancel it. Section 16 violated. Section 16 was the conditions for ITC. Rule 86B violated. 86B, where payment chapter, where 1% needs to be paid through e-cash ledger if your turnover of that month of taxable supplies exceeds 50 lakh and you are not covered by the exceptions, then 1% you have to pay through e-cash ledger. You can't use entire e-credit. Then bank details not given on time, because bank details have to be submitted within due date of GST return or 45 days from the grant of registration. So if that is not done, then again officer can cancel it. And last one is anti-profiteering measures not followed or contravening anti-profiteering measures. You would have read this in miscellaneous provision saying that you cannot profit from the government. I mean, if the GST rate is reduced by government, you should also reduce the prices. You should not increase the base price and earn more where government has given a benefit. Anti-profiteering. Then second one is not filed return for 6 months. And if you are under QRMP, then you have not filed for 2 quarters. What is QRMP, sir? Quarterly return, monthly payment. 2 quarters is also 6 months. And composition dealer, if he has not filed the returns for 3 months after due date. Composition dealer files one return GSTR 4 annually. The due date is 30th April. So 30th April plus 3 months. He has still not filed the returns. Then officer can initiate cancellation proceedings. Third, taken voluntary registration but opts out. Taken voluntary registration but did not commence business for 6 months. So you have taken registration voluntarily, but it's been 6 months, not commence business. Again, officer can cancel the registration, initiate cancellation proceedings. And last one, taken registration by fraud, willful misstatement, suppression of facts. A rental agreement was given, but there is no premise there. Details given, but there's no such person available. Someone else's Aadhaar card used. PAN and Aadhaar was wrongly used. Then in that case, if registration is taken by fraud, willful misstatement or suppression of facts, have to cancel your registration. Then let's see what happens during these proceedings. People, understand one thing. It will take time. Say suppose you make a application. Once you apply, then officer will issue a notice. He will reply again to the points which he has raised. Then again satisfied, not satisfied. So by the time order comes, it will take time. During this period, should I file returns and can I make taxable supplies? There was nothing mentioned on 1st July 2017. Then government brought a point called as suspension, that from the date you make the application or from the date from where you want cancellation, that is from the date when you have sought cancellation, whichever is later, from there the registration is suspended. Say suppose I closed my business on 17/6, I apply on 19/6, from 19/6 suspended. Say suppose I apply on 19/6 that there is going to be a change in constitution of business from 24/7, I apply in advance, then from 24/7 it is suspended, whichever is later. I'll again repeat, from the day you make the application for cancellation or from the date from where you have sought cancellation, whichever is later. In this particular period of time, suspension. Okay, then here also it will take time. Officer will first issue a notice, then you will reply, then satisfied, not satisfied, and then cancellation will happen. So here also from notice to order it will take time. Here also officer can suspend the registration, and here suspension date will be determined by the proper officer. Again, whenever this suspension happens, you cannot make taxable supplies. That means you cannot collect tax from customers. Yes, after that if suspension is revoked, then in that case for that interim period you can revise invoices and collect tax from the customer based on those revised invoices. But during the suspension cannot make taxable supply and obviously not required to file GST returns during this period. Then there's one more power of suspension additionally. If the proper officer finds significant mismatch in the data submitted through returns, that is 1 and 3B or 2B and 3B, if he finds significant mismatch or based on any other analysis, he may suspend the registration, giving 30 days time to reply. Immediate suspension, special power available. In this case, 30 days time limit will be given for replying as to why the registration should not be cancelled, but suspension will happen immediately. So this is a draconian power, but it's there in the law. And suspension, you cannot make taxable supplies, so your business comes to a standstill. Now there are some cases where Aadhaar authentication is also not required, like government department, local authority, public sector undertaking, person who is not a citizen of India, a person who applies for UIN, unique identification number. These are not required to authenticate their Aadhaar. So when they are not required to authenticate Aadhaar, will fraud, willful misstatement, etc., points, etc. apply for them? The answer is no, because some people are not required to authenticate Aadhaar as per the law. Okay. The last point in this chapter is revocation. Section 30. Can we apply for revocation? Yes, 30 days from the date when you receive the cancellation order, and only in case of suo motu cancellation, because if you have only made application for cancellation, then you cannot do this. It's only for suo motu cancellation. So suo motu, within 30 days you can apply for revocation, plus you can take approval from additional commissioner, joint commissioner, and extend it by another 30 days if there is reasonable cause, and one more extension of 30 days with the help of commissioner. So revocation 30 days plus 30 days, here it is additional commissioner, joint commissioner, here commissioner. But if a person's registration is cancelled due to not filing returns, then till the effective date of cancellation, whatever returns are due, first you have to file that. After the effective date of cancellation, system will not allow you only. So those returns you can file within 30 days of revocation order. From here you get 30 days time to file all these returns. Let me explain it to you. Say suppose 1st Jan I stop filing returns. Cancellation happened on 1st July. 6 months I have not filed. 1st July officer cancelled it. Now if I apply for revocation, before applying for revocation I have to file all the returns here. Obviously, na? Because that has to be filed. Then these returns from July onwards, say suppose the order comes on 110. These returns for July, August, September, I cannot file it without the revocation order. But once I get the revocation order, within 30 days I have to file the balance returns. Plus, say suppose my cancellation is effective from 1/1 only. Officer had retrospectively cancelled my registration. Then all the returns from 1/1 to 110 have to be filed within 30 days from where I get the revocation order. Officer cannot reject my application unless he gives a reason to me and opportunity to be heard, which is the principle of natural justice. So this was about section 30. The time limits for cancellation, order has to be passed within 30 days. Revocation, again officer has to pass the order within 30 days. But there is no deemed cancellation, no deemed revocation. Be careful about these two things.